Ladies and gentlemen, my name is Michael Drury. I am the chairman of the Global Interdependence Center, and I'd like to thank you all for joining us here at the first annual La Jolla meeting. We're going to make them do it again. Payment systems in the internet age. I have three responsibilities up here, according to my boss, Jill Fernito, who is responsible for all things GIC. The first is to introduce our upcoming programs for all of those who are interested. For the adventurous who want to stay in the United States, a week from now on Friday, February 17th, we have Dan Sullivan from the Chicago Federal Reserve speaking in Sarasota, Florida. For those who are a bit more adventurous and want to go overseas, that weekend leading up to February 20th and 21st will be in Singapore with Loretta Mester from the Chicago Federal Reserve Bank. Cleveland Federal Reserve Bank. For those that can't get to Singapore in a week and a half's time, we'll be going on to Madrid on March 27th and 28th with Charles Evans from the Chicago Federal Reserve. Then we'll be reprising our bottom line of disabilities in Salt Lake City in conjunction with the Columbus Community Center on April 10th. Then we return to Philadelphia, our hometown, for the longest running event in GIC's calendar, the 35th Annual Monetary and Trade Conference on April 21st. We return internationally on May 1st to Paris for a GIC roundtable dinner. And then we have our 9th Annual Rocky Mountain Economic Summit in Jackson Hole, actually in Victor, Idaho, over the Teton Pass on July 14th and 15th, and we have just confirmed that we will be going to Tokyo on November 13th for the last program of this year. I hope that you're interested, that you'll go to our website, www.interdependence.org, and take a look. Become a member, become a speaker, become a sponsor. Yeah, become a sponsor, please. No, and we hope that you're all interested. My second responsibility here is to thank our sponsors, InsureCard, represented by Bob Menti, and Altigris by Kirk Strawn. I saw them both in the room somewhere. There they are. We thank them both for the support for this conference. And well, he disappeared, Steve Saxauer, for putting this conference on, and all of those who assisted him. And then finally, to introduce our keynote speaker, I just blanked. Yeah, I was going to say doctor, and I went Dr. Phillip. No, that's wrong. Dr. Patrick Harker of the Federal Reserve Bank of Philadelphia, better known as our landlord at GIC, as we are housed in his building. Prior to being the president of the Federal Reserve Bank at Philadelphia, he was the president of the University of Delaware, and prior to that, the dean of the business school at the University of Pennsylvania, Wharton. And a long snapper, as we learned last night, for the University of Pennsylvania football team. He said to keep it short and sweet. I've already screwed up his name, so sorry about that. And I can't blame the Stout as we did in Dublin. We thank you for all of your appearances here on behalf of GIC. Patrick Harker, thank you.
Well, good afternoon. For the Patriots fans, congratulations. I'm a lifelong Eagles fan, so this is painful either way. But I think everybody looks like they've recovered pretty nicely. This is the highest day for absentee appearances at work, or non-appearances at work. So the fact that you've shown up, you should all just be very proud of yourselves to show up after the Super Bowl. But I'd like to also say, not only am I a proud Eagles fan, I am a proud and loyal son of the Federal Reserve System's 3rd District, which encompasses southern New Jersey, Delaware, and the eastern central portions of Pennsylvania. I'm proud of the people, the places, and our contributions. And with that said, I want to thank Jill and Michael and the team here at GIC for getting me out of that weather and here to San Diego. Although it's 53 and sunny in Philadelphia today, So we're here today to discuss payment systems in the internet age, a subject that could occupy a full month's conference, and that brings up many interesting complexities for anyone interested or invested in the subject. It's also something of a complex topic for someone involved in regulation. So I should note from the outset that the views I express today are mine alone and do not necessarily reflect the views of anyone else and of my colleagues in the Federal Reserve System. So with that disclaimer out of the way, I'd like to talk today about how fintech has evolved and the role it plays in the overall financial system. And that involves going back to first principles, because whenever we're dealing with emerging areas of regulation, it's important to address what that oversight is and isn't addressing. So those of us who have been watching the evolution of what we now call fintech can probably agree that it existed before the headlines it's garnered over the past 5 or 6 years. That in fact, they reflect changes that have been in motion since the 1990s and 2000s, the early 2000s. Now, I don't want to diminish the inventive spirit evinced by the tech sector, but it's important to remember that the application of technology to financial institutions and functions has been going on for quite some time. We sometimes forget, with the incredible innovation coming out of Silicon Alley and Silicon Valley and Silicon Beach and all the other hubs this country has produced, that the tech revolution is advancing into middle age, which is only to say that we've been watching the disruption of various sectors, even ones as staid and resistant to change as financial services, for quite a while now. We've gone from hardware-oriented to software-oriented innovation, and IT has become much more sensitive and responsive. Internet capabilities have advanced by leaps and bounds just in the past decade, changing the game for front-end functions. This makes it possible for startups to reach consumers in a way that only banks could do 25 years ago. In many instances, for example, prepaid cards, this has inverted the relationship between consumers, service providers, and banks. So, if you ask anyone who's old enough to have witnessed the industry evolve over this period of time, a time when many of the people creating today's software were just being born, you'll hear that major change has come. But also, in some ways, everything old is new again. We're just finding new platforms. Take peer-to-peer lending, an area that's captured particular attention. Lenders and lendees are connected in ways they haven't been before, and there's a spirit of inclusion and a feeling of active participation, which is wonderful. But even that movement is essentially adding a technological edge to something we've been doing since humankind embarked on a system of goods and trade in kind. In my day, it happened over beers at the corner bar, right, where Eddie asked Joey to loan him a 20. Peer-to-peer lending has been going on since time immemorial, what makes fintech different is that the scope of its ability to match people with one another is infinitely broader. Which brings me to what exactly we mean by fintech. While it doesn't have a fully accepted definition, I think we can all agree that fintech is more or less the application of technology to the financial services sector. It may seem odd to define it, but there is honestly some confusion with so many firms calling themselves fintech. And you know, there's a wide array of what people are calling fintech today. I think it's good to lay down a baseline. So for the purposes of our discussion today, I'll be talking about fintech firms as those who apply technological innovations to financial functions and systems. Also, for the purposes of our discussion today, I'm going to get even more basic and establish what those systems are, why they exist, and what underpins them. The evolution of financial systems and intermediation has been studied and commented on for centuries. It evoked renewed interest after the global crisis as people began to re-examine the purpose of markets and the role of financial systems. While there's a lot to dissect with regard to the various innovations of financial vehicles and the ways in which institutions are structured, a financial system is fundamental to the human experience as we know it. These systems evolved because humanity is driven to find comforts beyond subsistence level living. We can't buy food or shelter in the modern age without a system of payments, finance, and credit. And our incorporation of a financial system has existed in some form for most of our history. Whether it's trading or banking, societies across the globe have operated on the premise of, you have something I want or need, and I will give you something in exchange. From the central agora to apps on our phone, whether it's a creditor's note or a series of ones and zeros, the essentials of the system have stood the test of time. At its most basic, the financial system exists to keep savings safe, to ensure that people and businesses can easily price, buy, and sell things, and to make certain that we can all use our financial resources to their best advantage, whether that means paying for food and housing, getting an education, expanding businesses, or investing our assets. This is critical for all of us, because a strong and sound economy can only exist when it's underpinned by a strong and sound financial system. And what underpins a strong and sound financial system is trust. Adam Smith said, all money is a matter of belief, and it naturally follows that all financial systems are a matter of trust. A financial system can only exist if we collectively agree to it. A system of savings, credit, and exchange and investment survives because we have the faith in people we don't know. Currency we have no individual control over, payment systems with inner workings we don't see, and institutions we grant power to, both to house and to regulate those systems. So why do I mention these? Because they are central to the next step for FinTech. While I noted that FinTech is just the latest iteration of changes we've been seeing for a few decades now, it is still new from a regulatory standpoint, and it's likely heading into uncharted territory. It's unlikely that increased oversight will be welcomed with open arms. We know that. But I should say now that it's actually in the interest of FinTech firms, in part because they exist in a business environment that is much more Silicon Valley than Wall Street. FinTech firms, by and large, do not see themselves as banks, but many of them are ultimately financial institutions. Banks, of course, by definition, are institutions that take deposits and make loans. While many FinTech organizations see themselves as mere facilitators, if they are providing the essential functions of a banking institution, that does pose questions about regulation. And if they're subject to oversight, it's better for them to understand what it takes to be compliant from the beginning and not later. Regulation being the great boogeyman of the industry, I'd like to note that regulation is necessary for a functioning system. The trust that underpins the financial system is either earned or guaranteed by people or institutions. One of the ways of conferring that trust is to promise that mechanisms are in place to safeguard the system. FinTech firms need that trust the same as any other bank or financial institution. This underlying expectation, it's why it's best to get in early on regulation. It's in these firms' self-interest to provide a layer of trust building that regulation can offer, particularly those that are getting to scale where negative events could have major consequences. This is especially true because most FinTech firms today haven't seen the downside of a credit cycle. And in those moments, trust is shaken. Any student of economic history has to acknowledge that, like death and taxes, a downside to the cycle is inevitable. The aftermath of the cycle's end will determine a lot of the character and contour of what sort of company can survive in this space. That alone should be cause for FinTech to want some form of oversight. What FinTech outfits don't want is regulation that comes in after a crisis. That type of regulation almost always fights the last war, and that could mean tighter strictures and less room for innovation after the crash at the end of a credit cycle. Policymakers have too much experience with the old adage that history may not always repeat itself, but it often rhymes. So, I think there are two things to focus on when talking about regulation. First, that it's structured to protect both institutions and the public. And second, that we consider what regulation already looks like and where we think it's headed. I have to stress that as a Federal Reserve Bank president, I have no hand in drafting regulations. So forgive me if I veer on a Monday after the Super Bowl into a little armchair quarterbacking. What I am able to do is talk more broadly about what's been proposed, the examples we have to look at in other countries and regions, and what I think is likely to occur. The European Union has given us some measure of comparison for the OCC's proposed measures, which remains the most comprehensive attempt at mapping out a strategy in the US to date. In particular, a lot of commentary in the payments industry has drawn parallels between the European Commission's Payment Services Directive and the OCC's proposal to grant national bank charters to fintech companies. Fintech firms vary widely in their business models. While some provide payment-related services, others offer loans to consumers and businesses, provide digital currencies, or offer financial planning or wealth management services. For fintech firms whose business falls more on the payments end, there is some comparison to the European model. The Commission's directives ask that these type of firms be licensed and satisfy other general requirements. The closest analogy we have in the US is state regulation and supervision of money service businesses. Some fintech firms that fall under this umbrella are unhappy with the idea of having to obtain many, if not dozens, of licenses to operate around the country. The proposed OCC charter may offer them some relief. On the other side, to the extent that the fintech firm is weighted toward making loans, especially the consumers, the payment systems directives don't quite correlate. For that, a better comparison is the Commission's Task Force on Financial Technology, which makes policy recommendations on fintech in financial services. They formally incorporate viewpoints from multiple regulatory bodies, not just banking regulators, which sets the European model apart from the OCC's suggested framework. There's an open question about whether or who should supervise fintech lenders in the United States, made all the more complicated by the interplay between our state and federal regulatory frameworks. Most personal finance companies, for example, are licensed and regulated at the state level. Uncertainty about the boundaries between these two competing spheres of authority can be seen in some states' reaction to the OCC's proposal. But particularly if we're talking about loans to consumers, it's only a matter of time until federal consumer protection will come into play. All of which is to say, it's complicated. But it continues to be, in my opinion, in the interest of fintech companies to be regulated. This may sound like particular nannying of sometimes somewhat regulator asking for more oversight. I'm not speculating at all that the Fed will be involved in this fintech regulation. But I can say none of us are trying to stifle innovation. If anything, you'll hear us praise the ingenuity and imagination that comes from the technology sector. But there are risks, and we should be talking about them. Regulation can't solve everything, and it can't anticipate or guard against every problem, but it can try. For me, regulation is not just a question of protecting consumers. It's actually a question of protecting the innovators as well. It's in their best interest to have an established framework in which to operate, as opposed to ambiguity. In part because the trust it engenders will underpin their essential role in the financial system. And again, it all comes back to trust and its critical role in the financial and economic systems. Whether it's Eddie borrowing a 20 off of Joey at the corner bar or the loan officer at our local community bank, we trust people to act in accordance with an agreed upon code, both the legal one enshrined in legislation and the moral one we've entered into as a society. Whether it's a structurally important financial institution or an app on our phone, we trust institutions to hold up their end of the bargain we struck when we deposited or borrowed funds. And whether it's administered by multiple agencies or a single body at the state or federal level, we trust that there's a safeguard in place to guide and protect the companies we're entrusting with our economic livelihoods. Thank you, and I think there's time for some questions. Thank you. Jill is back here with a microphone.
Thank you. And for people asking questions, if you just mention your name and when you start. So Steve Sexton.
Okay.
Tom's ready.
Tom Sinat worked for 36 years or so at U.S. Trust Company of New York. I now teach at Cooper Union.
Oh, great.
My question is, should the small banks have to meet the same standards as the big banks under Dodd-Frank?
Yeah, that's a good question. So I think we step back a little bit and look at the history of regulation, right? And it's not just about the crisis, but it's always the case. The pendulum swings one way and then starts to come back. In a moment, and that's why I was pointing out, it's better for the fintech firms in particular to look at this ahead of time as opposed to after a crisis happens. Because it's always the case, right, that we close that proverbial barn door in that crisis. And we swing the pendulum very far. And I think what you're seeing now already is the pendulum starting to swing back. So for example, in our regulatory world, for the state member banks, the small bank that we regulate, we're starting to look at extending the time between visits at the bank, between examinations, from 12 to 18 months if the bank's in good standing. That makes perfect sense. We're also trying to, in addition to removing some of the burden that they have, some of that we can do, but some of it Congress would have to do as well, of course. There are other things we can do. And so we're working as part of the system in building technology, and Philadelphia is one of the leads in this, where we're building technology so that supervisors don't have to spend so much time in a bank. Because we know when we show up in a bank, especially a small bank, a community bank, right, it's like a fire drill for them. I mean, they have to spend time with us, and so the less time we spend in that institution, and the more we can do offline through quantitative tools, right, and through different tools that the supervisors have, it's a win-win. It's a win for our supervisors, and it's a win for the banks. And that's particularly true, I mean, even from an HR perspective for our supervisory staff. You realize, you think about the Minneapolis Fed, right? So the distance between Minneapolis and Washington is shorter than the distance between Minneapolis and their branch in Helena. And so the regulators have to spend time, the supervisor staff has to spend time very far away from home. So I actually think there's a win-win here outside of the regulatory framework. I think there are changes that need to be made, especially for small, non-systemically important institutions. And we have to be careful about that phrase too. They may not be systemically important when it comes to the economy as a whole, but they are systemically important to Altoona, Pennsylvania, right? And so we need to continue to make sure that they're safe and sound and the consumers are protected. But but the risk, right, the risk tolerance is a little different vis-a-vis a LISIC firm, right, a large institution. So I completely agree. I think the pendulum is already starting to swing back the other way.
I'm Bob Eisenbeis from Cumberland Advisors. The Fed is responsible for stability of the payment system. And now when we have all of these different payment options, the issue of hacking and security becomes really critical.
Yeah.
And obviously, when you've got merchants that are involved interfacing into the payment, how do you get your arms around those issues and still accomplish your mission?
Boy, that's a really good question. So just put a little context around that question. So every year, we go out in Philadelphia, the Philly Fed, and we meet with all the banking community throughout the district. We call it our field meetings. We've been doing those for over 75 years. We survey the bankers ahead of time, and these are all small institutions. Number one on their list, the things they wanted to talk about, it wasn't credit risk, it wasn't interest rates, it was cyber threats. I mean, this is top of mind for these small institutions because they know they can lose the institution. So it is something that is evolving, I would say. I don't think, at least I can only speak for myself again, I don't think we have a firm handle on exactly how to deal with this. We are adding this into our supervisory function. That is now, banks are being graded on how they're handling cyber threats. But one of the challenges that we have, if you're a large institution, you can spend a lot of money on this. If you're a small institution, typically what you've done is outsource this to a third-party vendor, right? So there are a couple of major players in the industry, and so it's also spending time working with them to validate their systems. Because the small banks can't afford to do that on their own, right? This gets back to trust. They're just trusting that these firms will deliver what they say. And some of the examples of near misses or significant problems when it comes to hacking, several of those I'm aware of have not happened through the front door of the bank, but through the back door, through the third-party vendors. There was one sort of classic one that is running around the industry right now, which is an unlimited cash-out scheme, where hackers get in, they dwell for about 250 days in these systems. It's like casing the joint, right? Like everything old is new and new is old. So they're still casing the joint, they're just not hanging out the coffee shop across the street from the branch, right? They're hanging out in your systems. And then what they do is they remove all the limits for ATM withdrawals and transfers. And then just, bam, they just start taking the money. And then this money just floats through the international financial system very quickly and disappears. So those sort of things are happening, but again, the bank in and of itself can't protect itself unless that vendor has protected the system. That is something that I'm increasingly concerned about.
Thank you. Kathleen Stephenson from Huawei Technologies. I'm going to ask a very, perhaps, basic question, and that is, can we draw a parallel with fintech and what happened a few years ago with the development of the shadow banking system?
Maybe. I mean, that's an interesting point. Maybe. I mean, of course, the shadow banking system, there are many players there that have come to scale, right? And they were there already in different forms. In the case of fintech, it's as these institutions come to scale, and if they're making loans to consumers, there's still going to be regulation that will have to, they will have to abide by both at the federal and the state level for consumer protection. Or if they're taking deposits in some form, they're still subject to an array of regulation, Bank Secrecy Act, anti-money laundering, and you name it, right? We can go down the list of the various. So they can't be completely devoid of those regulations, as opposed to maybe some other institutions. So it's not a straight analogy, but because I think the space that many of the fintechs are playing in right now, whether it's payments or loans or peer-to-peer lending, there's already a regulatory framework in place that they're going to have to abide by at the state or federal level day one.
Patrick, when we were in Dublin back in September, and I remembered your name,
Yeah,
that
come on,
was for
St. Patrick,
discussion.
huh?
That was for discussion on fintech. We're here for discussion on fintech. And last night at the dinner table, we were talking about the Chinese perhaps starting their own digital currency.
Yeah.
What's the level of competition or cooperation on developing the regulatory network for this burgeoning international field?
So I think there's two issues. One is what's going on, and I think right there we're just kind of in a exploratory, as a system, exploratory, trying to understand it, trying to get our arms around it. There's a recent paper that was just put out about distributed ledger technology more broadly, and in that cryptocurrencies, and just our best understanding of what we know to date. It came out of Cleveland, I believe, just the other day. It hit Fed in print. So you should take a look at that, because it'll give it I think that's a good summary of the best thinking to date around what the system is thinking and learning about this. So we are not in any way, shape, or form prepared to launch our own fiat currency of that form that others have talked about, because I think it's still way too early to make decisions of that magnitude, right? I don't see any of that happening in the near future, except for us trying to understand its implications. It's not yet at the scale where it would create systemic risks generally, but we have to watch it. There's no question that this is one where we continue to have our staff throughout the system, not just at the Board of Governors, but in all the banks, trying to understand what's going on, what's the scale, what we're seeing as the potential risks as this emerges. By the way, beyond cryptocurrency, I mean, distributed ledger has a lot of other advantages for other areas like contracting and so forth, which is also very important.
Steve Sexauer. Follow up on Michael's question. we've learned that the economics of the internet and wireless are basically borderless, connectionless, and extraordinarily cheap. So do you think at all in that dimension of I'm supervising a global system versus the state, the country?
Yeah, that's a tough one, right? I mean, people have written on this. People have tried to get their arms around it intellectually. How would you approach such a thing? You know, we have actually an interesting model here in the U.S. because we have the U.S. and we have the federal and the state regulatory frameworks. Gets orders of magnitude more complicated when you start to think about harmonizing across the globe in a whole variety of ways. Now, we've done that in the past, Basel and so forth. We've tried to create some harmonization. But this gets back to institutions fundamentally. Who does that harmonization, right? Who does that coordination? It typically has to be some institution that we trust with their membership has the ability to create that kind of harmonization. I worry about that in the world we're in today, right? That those institutions that try, in whatever sphere it is, and we're here speaking about financial services, that I hope that we don't lose their ability to convene the member countries in this case and to come up with reasonable, prudent approaches to solving some of the risks or mitigating some of the risks that are in that system. That's what it ultimately comes down to, is those institutions themselves, the Fed being one of many players in that conversation. People ask me what I lose sleep over. That's one of the things I lose sleep over. Those global institutions continue to be important because whether we like it or not, and whether people like it or not, I don't see globalization going backward. And just simply because technology and what the human desires will not allow it to happen. I could be wrong, and I would admit I'm wrong, but this trend, there may be little bumps along the way, or along the road, but I don't see it reversing completely anytime soon. So that means we need to continue to have global institutions to provide the frameworks, right, that one can manage the risks that are inherent in that cooperation. That's it. Thank you very much. Thanks, Joe.
Thank you, Patrick, for starting us off on the first annual Payment System in the Internet Age program. I'd like to introduce Steve Saxauer, who helped put together this whole program, and he will introduce the first panel.
So one of my roles here as the panel comes up is to just give you the organization for the afternoon, especially for those that have not been to a GIC conference. So if you look at the program, you'll see an agenda, and it lists the 3 panels. So just a quick note on how the panels work. Typically think 2/3 content the panelists are sharing with the audience, 1/3 back and forth. And the goal really is to have an interactive back and forth. So if you have a question, we'll spend as much time on it as necessary. And then I'm going to just briefly walk through. You can see the questions on the screen. And this is basically a summary of the questions that I've gotten over time, and actually questions internally between the moderators. And so the panels are somewhat organized to answer them. So if you look at the first question, just what is a payment system? And how do they operate today? And by whom? And that'll be the first panel. We actually have Bob Menti, who runs a payment system, and it's part of the new technology. And then we have with us Livia Sasbo and Peter Malarick, who are getting ready to launch these new digital currency-based systems. So they will go through how they'll work on both sides, and you'll have some concrete content, which goes to basically the next 2 bullets is what is money, what is cryptocurrency, what is a digital currency. That kind of started out as what's Bitcoin and how's it work. But there will also be some content of the history. I think Warren's going to talk about, we had in some ways Bitcoins back in the 1800s. And for that panel, it would be very, very challenging to find 3 people who know more about the payment system, money, and economics, and I'm thrilled that they're here. And so Bob Eisenbeiss is going to moderate that panel, and then we have Rod, and we have Warren. I think you're just going to think it's fantastic. And then that leads to the final part is, like, who guarantees these systems? How are they secure? And are you willing to give up all your anonymity for the benefits of the system? That panel is going to be, from a technology standpoint, I think one of my favorites. Dave Altig, who's research director at the Atlanta Fed, is going to moderate that. And Preston McAfee, who's the chief economist of Microsoft, has a fantastic presentation on the Internet of Things. The first time I saw it, it scared me to death. So we'll take a poll afterwards. And then Jamie McAndrews, who's recently retired from the Federal Reserve System and has really spent a lot of time on this issue of anonymity. So we'll kind of close with that. And so each panel will be, 2/3 presentation, 1/3 Q&A. And I'm just going to launch with a picture back to President Harker's speech. So this is the iconic picture from Chicago looking south down LaSalle Street at the Board of Trade. And what you have on the sides are 2 opposing temples. Corinthian architecture, 65-foot columns, and if you remember the 1987 book by William Greider, Secrets of the Temple, it's money, it's trust, it's power, it's reliability, it's everything President Harker said. Now, a couple little footnotes about how the future unfolds. The building on the left is the Continental Illinois Bank building. And as you know, in 1984, there was a run on the bank as they melted down in conflagration of energy loans. And they were saved by the system across the street and the FDIC. And in fact, that's where the term too big to fail came from. The FDIC announced they would not let the 11 largest banks quote unquote fail. And in a conversation with the comptroller of the comptroller of the currency at the time, Conower, with Senator McKinney said, let's not, I think it's not mince words, but it was similar to that. You've created a new kind of bank called too big to fail. Now my footnote on that, and the reason I'm doing this about trust in the system, is the bank on the right, which is identical in architecture, was built afterwards. And my GIC friend and colleague, Harvey Rosenblum, who retired from the Federal Reserve System just in the last year, was research director in Dallas, shared with me at dinner last night that the history here is when the Federal Reserve was formed, they weren't sure how long they would last because we'd already had 2 failed central banks in the United States. But they had to use public money to build a building, so they literally hired the same architect that did the Continental Bank. And if I remember the story right from Harvey, is they said, build a bank that looks like that, so if we're not around, we can sell it. and so this is, and as we now know, the central bankers are the rock stars of the world, and they have been for 8 years. So with that as my introduction, I'm going to turn it over to Bob Menti, and I am not going to do introductions of the panelists just to save time. The resumes are in the book, and they're fantastic. And so I'll come back up and moderate in a little bit, but I think we'll get Bob's slides up, and we'll be ready. Hopefully we will. Any questions on the format or anything? And don't be bashful with the questions.
While we're waiting for the slides, on our 75th anniversary, we did do a major renovation, which converted the interior to look less like a bank and more like the Federal Reserve that is today. After we left for 75 years, we got a few more years to run.
That was Bill Strauss from the Chicago Fed. All right, Bob.
Okay, and I know that you're there. I'm a little hidden, but that's fine. I will. I can do that. I can stand up with the microphone. What?
I got it.
You got it? Okay. No, I just felt a little strange. Thank you. That's okay. Well, I'm not really sure that works. So, good afternoon. As Steve said, I'm Bob Mentee, and I'm president of InsureCard. We design payment systems for insurance companies. Typically, we use debit cards, virtual cards, truthfully, whatever meets the need of the industry and the one that we're going to make money on. And so it's kind of the theme of what I'm going to tell you, and that is that we had to go into a very traditional industry where there were several restrictions and build products that would meet those two needs. One is they would meet the needs of the customer, and secondly, we would make money on that. And the people who designed the banks that worked with us, everybody along the line had to make money, or else we can't deliver these products. My background is in insurance. It is not in payments or in banking. So this is very interesting. Everything is a revelation that you're saying right now. I spent 25 years working for Cigna, mostly in regional management, and then running large projects and doing claims processing, both internationally and domestically. When I left Cigna, after they were purchased, I started doing consulting for some of the largest insurance companies in the country. As part of that, I set up outsourced call centers in Ireland when everybody was putting parts of their company over in Ireland. I did that both for Cigna and for Prudential as a consultant. And that quickly made me an expert in call centers and in outsourcing. So I was hired by other industries and worked for Discover Card and US Bank and saw what was happening in the new payment systems that were coming through. And they looked to me like the benefit programs that were being paid by the insurance industry, the workers' comp payments, the same things that the states were doing. And let me grab this. The same thing that the states were doing to pay benefit systems, it looked like the insurance companies were doing. So I went, along with the consultants that I had picked up working on these projects, and took that idea to insurance companies. We then sold those projects, and it was, we were told, however, at that time, that we would never get them built. And this was the reason why. In insurance, everyone is concerned about regulations. And this is what Patrick was talking about, that part of this is always regulations. And in insurance, it's state-by-state regulations, and which meant that any change that came about, especially payments to customers, had to go to and be approved by every state. The political appointees, who typically were on the workers' comp board, changed with the wind. They changed with an election, they changed with a better job, they changed with somebody not liking them. And so when we got into this, it was easy to get banks interested because this was kind of the holy grail. Everybody knew that workers' comp payments equaled about $65 billion a year, and that 90% of them were being done by checks. That wasn't happening anywhere else. Everybody else had moved to other payment systems. So, so we got into this and worked with Ernst & Young, we worked with Oliver Wyman. They all put together studies that said regulations showed that about 26 states were already approved, that their regulations already had us there. We quickly learned that we we had the wrong idea, that everything had to be in writing, because the insurance companies realized that we could get fined by these regulators, and the guy who's there today is unlikely to be there next year. So it had to be in writing. People told us that was impossible. So we'd never get the big states. These guys are bureaucrats. They will never put anything in writing for you. So we had to go and get the right lawyers. And we got the right lawyers. We were able to do this. It was easy then to turn around again with that $65 billion on our side to convince the banks to build the products that we needed to meet the requirements of the states. The banks were also a problem when we started putting this together because, as mentioned, they're heavily regulated. And the banking, there was money laundering laws. We had to worry about CIP, the customer identification process. I don't think that's spelled right, the Durbin Amendment. All of a sudden came in halfway through this, so we had to change banks. And I'll mention in a minute when we got into medical payments how difficult that became, because all of a sudden we had a whole new set of regulations to deal with. These are some of the other areas we tried to convince people that the Fed and the state were already there. Macy's was putting out debit cards when we were doing this. So this may sound like all old technology to you, debit cards, and we eventually used fax machines to get around another problem. It was new stuff to the insurance companies that we were dealing with. It still is a revelation when we take this out to them. This is eventually what we did. Every blue state there, we have the regulation in writing. And actually, South Carolina, 3 weeks from now, will become a blue state. So we're down to 3 states that were left. The 2 states in maroon, they're called monopolistic states because only the state can issue workers' comp payments. So they don't count for us. But we were able to get there on this. And to date, we're the only people who have been able to do this. Today, those barriers that we had then are a blessing, because quickly after we started, Bank of America came in, Chase came in, Xerox came in, they all came in with products, and those 3 that I mentioned have disappeared. Some had limited success where they had a single state insurance company and they could deal with that. We can do the whole country. So on this, we're there by ourselves. We started to build other sets of products. And for workers' comp, the other end of the product was payments to doctors. Now, payments to doctors is a big part of workers' comp payments, but it is also medical payments, it's also disability payments, it's also injuries from auto mishaps. So medical payments was all of a sudden the pot got much bigger. So we went to Visa, we went to MasterCard, we went to banks, trying to solve the problem of medical insurance. Nobody had been able to convince doctors to take electronic payments. Even in the Affordable Care Act, they spent 11 pages trying to convince the industry to take on electronic payments. They spend another 3 pages telling why nobody's going to do this, but that's in the law. And we took out, and there were lots of reasons. You got electronic, you audit trails, you got paid immediately. There were lots of things that doctors liked. But the problems were, every doctor needs explanation of benefits. It's like an invoice that comes with your payment. If you've ever gone to the doctor and sent through, you get like a $160 payment that you have to put in for an X-ray, and then you get something back in the mail that tells you that the insurance company will only only pays $93 for this. And we pay 80% of that, you have to pay the rest of it. That's the explanation of benefits. Well, the doctor receives these explanation of benefits along with their payments in stacks every day. Typical doctor's office gets paid by 200 different payers, insurance payers. So you try to send them some new system, and unless you're Blue Cross or United Healthcare, it's really tough for them to accept a payment system from you to begin with, because they're going to change your method of operating, and they don't want to do that. There's other problems. Besides the 200 doctors and besides the fact that they need that bill or they don't even know what it's for. If a check came in by itself or an electronic payment comes in by itself, they have no idea. They never charged anybody $93. So who is this for? Even if it has the person's name, it's likely they got many X-rays. And the insurance company may charge them something different. So those payments have to be adjusted. So this is where the piece comes in about using fax, if you saw this on the agenda. When we try to set up something for the explanation of benefits to come to them, you find that there's information in there that says they used a drug that says they're HIV positive, or they're pregnant, or they're, something that they don't want people to know. So it can't be sent through a cloud. That information has to be protected based on HIPAA laws. So we went to several different people to try and help us design this. They finally we finally hooked up with a company in Texas that does aftermarket warranty programs for autos. And they were faxing the information to them. They could get it to them immediately, and all the different auto agencies had fax machines already. You didn't have to have any new technology. Fax is HIPAA compliant because it's a point-to-point transmission. So we were saying, can we do this? Will people start accepting this? People accepted it. We pay 500,000 doctors today. And we include a virtual card. Now, if you're not clear on what a virtual card is, if you use Fandango, say, and you ask for a payment system to take to the, a payment voucher to take to the movies, you can print that on your printer, and it has a little barcode. And what we set up was this. We send them a paper on a fax picture of a debit card, along with all the numbers they need and instructions for use. At the exact same time, not days later, they get a explanation of benefits attached to it. It can be scanned in. It's all set for use. None of this is what we envisioned when we were getting into the electronic payments. We take people's total, all their payments for the day. They send them to us. They send the EOB as a PDF, and we get them to the doctor at the exact same time. We have catastrophe cards that are activated on site using smartphones. We have Um, um, That's a little less interesting because it's just so common today that you can do these things. But as each new problem came up, we were using different tools to get there. But the problems were the same. How do we make money? Is there a reason to buy? Every doctor was complaining about getting the bills late, getting paid late. Every doctor has float problems. The insurance companies had to handle escheatment and voids and stops and everything on tons of payments. 3% come back void, come back to them. And so we needed to design products to address those problems. This is a very successful product for us, as is the first product that we have, that I showed you. And this is a big thing. I don't know that I stated it correctly, but is there a sufficient frame of reference for the buyer? One of the problems we have with virtual cards is we need, like, as you can see right now, a little bit of time to explain even what it is. And this is to insurance companies that deal with these all the time. We tell people over the phone that we have this product, and they said, I just need the debit card to pay the injured workers, because they understand what that is. So we say, okay, we'd like to show you the other one while we're there. And then we have sufficient, at least a couple minutes, to show them what that other product is. There has to be a frame of reference for the buyer. And then do we have enough profit coming out of it that we can convince the banks, the producers, and our investors that this is a product that we should sell. Now, as we go forward, there'll be all the products that you're talking about today, Bitcoins, things like this. This is all going to be replaced. The same problems will be around, and hopefully, we get to design those, but we need some innovation, maybe pull from the past, like the fax machine, or go into the future. That debit card, that medical payment I was telling you about, is totally funded by interchange. We don't charge anybody, we don't charge the insurance companies anything for them. And there's enough money coming out of that to fund that through interchange. So that's a nice product for us. The answers are easy on that. But we need that in order to push the whole thing through the system and develop it. So.
So we didn't have enough spots for the moderator, so I'm off to the side. So try and just anchor on all the things that Bob described just to get a transaction done accurately. And now Lydia's going to walk through a mobile payment system with units in her plan and the billions of users. And for the question to President Harker, no borders. So with that, I'll let Livia tell you about it.
Thank you. Hi, good afternoon, ladies and gentlemen. Thank you for the introduction. So my payment processing career started 25 years ago in Budapest, which was a post-communist country with just cash, nothing else. This is not from 25 years, this is just today, a transaction from a bank. So as my career growth in the last 25 years, and I've been working for the largest global companies in Central Eastern Europe, so do the financial services and the payment technology also grow. And there was a tremendous innovation in financial technologies. New innovative companies came, new technologies came, and in Central Eastern Europe we were always the early adopters because after the communist system collapsed, thank you, after the communist system collapsed, we haven't had enough time to introduce, for example, the check system. So immediately we went to the debit card and credit card. And when I was working for MasterCard, we were really lucky because all the other card companies was not there yet. So we were the first one, the most innovative card company that time. But of course, you know, the market changed and everything changed. And with my former colleagues and with my former team, not in a garage, but in my penthouse in Budapest, we started to think about why don't we start a big global company which could manage billions of transactions. And now I would like to introduce to you my new revolutionary venture, which called SupiPay, which is a mobile phone optimized payment system. We could process 4 billion transactions real time in a very low cost in our system. And we integrated most of the payment processes as available right now in the planet. If you look at this chart, which is from McKinsey, you could see that the electronic payment volume growing much faster than the GDP, which means that the global market's going onto electronic transactions everywhere. So in this chart, which is like a not so colorful chart, but the most important is like what is our system can provide to you or to the world. As I said, this is real time, so we don't have the 5-second delay as the halftime show was yesterday, because our transactions are really real time. It's just happening when you do the transactions. And we integrated any kind of account management into the system. So personal account, corporate account, government account, sensitive accounts, VIP accounts. The system can manage any kind of account, and also the sub-accounts. And again, the transactions within these accounts are real time. And the other very important point is that the system is centrally controlled. So we don't hold data in the other side of the world. We keep everything in one central system, which is controlled by us. And with this system, we can connect billions of people and billions of companies together on the same time. The system is multilingual, so any languages as we speak in the world, and we're not speaking yet, we could integrate it there. And it's also multi-currency. So when I do a transaction with my phone, I can choose whether I want to use US dollar or euro or Hungarian forints or Bitcoin or any kind of virtual currency. Or we can also create virtual currency in our system with a different brand or design or for promotional activities. We made a comparison. I know that we're going to talk about Bitcoin a little bit later. We made a comparison chart about what is our system can provide and what the current distributed ledger and Bitcoin systems are providing. We collected 12 characteristics. I am going to talk about the most important characteristics, which is one of them, the central control. So the Bitcoin or the blockchain doesn't provide what we created, that with one centrally trusted system, we could use all the data and know all the data. And the other important fact is the money issuing capability. So we are able to issue virtual money in our system. And circulating it in the system. Our business model is very different than the current payment systems. everybody is selling transactions. I was also selling transactions for 25 years in previous workplaces. So we decided to not charge for the transactions. So all the transactions are free, whether it's used by a company or a person to transfer payment to Germany, for example, or any kind of transactions. And we charge on the advertisement what is in the system for merchants and companies. So our business model is very similar like the Facebook and the Google, who doesn't charge for transactions, but we sell marketing, which is not really financial technologies kind, but this is how we find a way to make billions of dollars. And so this was my short presentation. I could also speak like a month how we developed it and why we did it. So I have a great team of experts of digital currency and also myself. If you have any question at the Q&As, I would be happy to answer it. And just the last sentence, that this is my new American baby or American venture to succeed and build up a global company. Thank you very much.
Hello, this is Jamie McAndrews, and I was just wondering what SupiPay thinks about these, the possibility of getting a banking license under these fintech licenses that the Comptroller of the Currency has announced. Thank you.
Thank you. The banking license is always a good question, but as a former banker, I know, and we kind of find a way how not to get into regulated under the banking regulations. However, it depends on which market we're talking about. Because in a few markets where we have partners who are interested in to use our system, they are commercial banks. So if a commercial banks log into our system or plug into our system, we are like a system provider as IBM or any of the large company. If we develop our system, let's say in the US, and we want to launch it as a Silicon Valley company, we might need to get a banking license because we're going to somehow compete with the banks. But it's all kind of under discussion, and there is a lot of big partners interested in for our system. The three letters name big companies and also longer letter name companies. So in the next couple of months, we're going to announce, which direction we're going to go.
So Libby, we have another question from this side of the room.
Thank you.
Hi, I'm Warren Weber. A very naive question, but how do you differ from Ripple?
So I'm getting back. So the way how we build up the company is first we created a core banking system, which is real time. And as we see, let's say the US market where there is 12,000 banks, and their core system had been developed in the 80s and 90s. They are right now not all of them can face the customer needs on the market and also the challenges what the other fintechs are offering. So we integrated not only the banking processes into our system, but we also integrated the current like Groupon, OpenTable, all kinds of CRM and loyalty kind of programs to our system. So the Ripple is not a direct competition to us. If I am looking for like a competition globally, it's more like the Alipay, the Chinese company, but I don't see Ripple as a competition.
Josh Mendelson, and a very naive question again. Just in terms of how, since your fees all come from advertising,
Yeah.
who decides or how do advertisers decide that they want to go with you? And is the choice of advertising in some way, however remote, linked to the information you may or may not, you may be gathering on your client base, on the users?
Yeah. So I think the best is if I tell you an example. So yesterday it was very cold when they took us out to the water, you know, in sailing. And I needed to buy a jacket because somebody told me that I underdressed. So in a real time or a real life, this transaction happens in a way that I needed to wait till the 3 hours boat trip was done, came back to the building here, get my card out, regular POS transactions, all that stuff. So in the today environment, the merchant who was selling me this jacket got their money maybe 3 weeks or 4 weeks later, and not the full amount of $100 what I paid for the jacket, but they need to pay for the transaction fee. They also need to pay the electricity, the POS system fee, and all that stuff. In our model, I have a phone, the lady has a phone, and on the boat we could do the transaction real time immediately. So nobody is really paying for the services over there. The advertisement is coming on a way that once I paid for the jacket for the lady knows my username, not my current name, the username what I use for registration in the system. So in the username, when she has it, she can sell me a new product or a new service, or just communicate to me when there is like a promotion in her store. So this is the channel what we're providing to the merchant. So the merchant will have almost immediate access to me instead of holding this information with the card companies where she or he never gonna able to reach me out. Did I answer your question?
So we'll do Q&A after Peter talks to us for a couple minutes. And as he goes up to the podium,
I won't go up.
you're going to talk from here.
Because I cannot read my notes if I'm up there.
Oh, all right, deal. I'd ask you to think about the following. So Bob walked us through how much detail he had to get right, even using faxes, and the regulatory burdens, and then that you had to be able to make money. It had to be a business that could pay the bills. So it somehow had to be the transactions. Livia's model is what I've deemed the Google Facebook model. It's free to the user, but the knowledge in the transaction base or the advertising should be able to fund it. And so that kind of frames something that in dinner conversations last night really came out as the magnitude of the services that can be provided and the cost. You have to give up some what? Anonymity, because everybody knows everything you did. One of the things I'm excited about Peter's talk is his background as a board member and a partner at Ernst & Young in tax in Germany and international business. He's going to walk us through a lot of the issues, including kind of ending his concerns about anonymity and how it works, which will lead into the next panels. But we will do Q&A before that.
Thank you, Steve. Yeah, I'm here because I'm German, and Steve asked me to do something unusual. So there is no PowerPoint. You can relax your eyes. I just will talk about a little bit how we see things in Germany and how it relates to the US. And as Steve mentioned, my background is accounting and corporate taxation. And I made a good living actually litigating the equivalent of the IRS here, the German IRS. And finally, in 2012, I could afford to move to California. However, I didn't know it's so expensive here, so I had to go back to work. And last year, my partner Frank, who is also here today, Frank, raise your hand, and we formed a company called Honey Inc. Why honey? Yeah, apple was taken already, and we wanted something fruity. So it is a fintech company, though. And I was also told no sales pitch, so I can only ask you to write down movehoney.com. That's our website. You can see everything we do there. Now I come back to my task. And I would like to start with a provocation, because I would actually say cash as you know it will be gone in 20 years. Why am I saying this? We see tendencies in Germany that the government actually wants to get rid of cash. They decided not to print 500 euro bills anymore. 500 euros is approximately $550. And so government says these denominations are only used actually for illegal activities, tax evasion, And so they made this decision. They won't actually take them out of the system, but they don't print them anymore. I also heard the US considers the same for $100 bills. Is this correct? I think it is. India has already replaced recently existing bills, yeah, because also their tax system is not working. Sweden and Denmark are pushing hard for digital currency. I think already 90% of transactions are actually conducted digitally. The cost to mint 1 and 2 cent coins is actually higher than the face value of the coins. Yeah, that's a big issue. And also, it is actually expensive to hold cash, yeah, because it gets dirty, you have to replace it, you can lose it. And so the Germans rejected, however, plans to abolish these coins because they're afraid of inflation, and I will come back to this later. Governments, especially in Germany, try to crack down on the black market, how we call it, money laundering, because they argue this is used to fund criminal activities and terrorists. And also, while the Super Bowl is a big thing here, in Germany, actually, tax evasion is the most popular sport. And not only in Germany, actually. To give you an example, in Germany, we have a sales tax. It's called VAT, value-added tax, and that is 19%. So on any good or service you receive, you pay a 19% VAT. And so people try to avoid it, and there are several ways. So if somebody says, you know, I don't need an invoice, that basically indicates he wants to start a negotiation not to pay the VAT. Or they say, can we do it black? And now I tell you a story here. A guy bought an old-timer. It was a Mercedes 300 SL, the one with the wing doors, and he had it refurbished and restored. Now it had to be painted. So he went to a special paint shop. They agreed on a price. It is a true story, actually, $10,000 approximately. And yeah, he wanted it in silver. And then the guy went home and he thought, $10,000 and 19% VAT, that's $1,900. Maybe there is a way to save it. So he called the guy, the painter, and said, you know, can we do it black? And the guy said, sure we can. And so 2 weeks later, the guy wants to pick up his car, and he was dreaming about his silver car. He saw the car and screamed because the car was black. So that backfired, but in many instances it actually works, yeah. And you easily understand, yeah, the government wants to crack down here because VAT is a major source, of course, and also I won't name other countries where it's very popular because I can only speak for Germany. So, and the last measure that governments took actually all over Europe is though there is a limitation for cash transactions. For instance, in Belgium, it's 2,500 euros, and the only country, actually surprisingly, is Switzerland. They don't have a limit, because in Switzerland, it's quite common you pay even for your car in cash. You walk into a dealership and pay cash. In Germany, there is also no limit, really, but there is a threshold when a merchant has to report. So if you transact 10,000 euros or more, there has to be a report to avoid money laundering. And so that's one thing the government does here. I said cash will disappear. Let's review a little bit existing payments. So we have cash, we have bank accounts, check, money transfers, wires, PayPal, etc. We have debit and credit cards, there's Bitcoin, and there's bartering. The problem though is, yeah, cash, you can lose it, it can be stolen. Bank accounts, checks, expensive, slow, not compatible for cross-border transactions. Whoever tried to transfer money actually from here to Europe or vice versa knows it takes forever, costs a lot of money. So people really don't like it. And also people don't trust banks anymore. The financial crisis actually led to a lack of trust here. Debit and credit cards are expensive. Bitcoin, it's an artificial currency, fluctuates in value. Nobody really knows who invented it, and it fluctuates in value, and we don't know how it works. People talk about blockchain, and everybody uses the term. Frankly, I heard actually there are probably only 5 people in the world who can explain it. I'm not one of them, so I won't talk about it. Bartering, governments really don't like it, yeah, because it's a shadow economy, and taxes are not paid. And also, I mean, look, if I gave you a haircut, Steve, you wouldn't like to pay me. So, when we founded Honey Inc., we looked for future solutions, and we think actually mobile person-to-person payment is one of the solutions because almost everybody nowadays has a smartphone, and the technology has developed so quickly. Internet is widely available, so it is actually possible to use these platforms. And again, since governments don't like cash anymore, we will have this development. And I see this also justified by the fact that we actually observe that banks are trying to develop these systems. There are apps already available. The German bank system is much different from the US. I mean, I haven't seen a check actually in 10 years. Yeah? And so in Germany, we just do transfers. We give our bank account number to anybody who wants to have it, because we believe they send us money. So it's a matter of trust. And that works fine in Germany. I learned here people are reluctant to do it. I wonder why, though, because if you send a check, all your information is on the check. So why wouldn't you give your bank account information away in the first place? I think it's just a matter of philosophy. It's just different over here. And so some players on the market already, there are companies in Germany that do already person-to-person money exchanges, and we thought it's now time to bring this to US. There are challenges, of course. One is building a secure system. I mean, hackers are everywhere, so when we actually developed our prototype, we thought we use Russian programmers, because they know how to hack. However, as you mentioned earlier, the providers are, of course, a problem. Yeah? You want to be sure there is no backdoor. So we might use Israelis actually to continue the work, yeah? And good code readers to check it. Building trust with customers, very important, and that is probably one of the major challenges, because basically what holds people back normally is either fear or lack of money, but also trust can be an issue here, and that will be one of the major challenges. And there's another story about an old lady who went to a bank in Germany and said, you know, here's my savings book, how we call it, and there's 20,000 euros on it. I would like to withdraw it. So the guy took the money, counted it, and said, ma'am, is there anything else I can do for you? She said, yes, please put it back. I just wanted to see it's still here. That's not going to happen with digital money, because you can't see it. You cannot go to a bank or anywhere actually to see it. You have to trust actually what's on your phone or wherever the account is held. It is there and you can actually get access to it and use it. Another challenge is various jurisdictions. US, I mean, we apply for money transmitter licenses. We have to do it in 50 states. It's actually very costly, $3,000 per state, plus compliance. You have to file forms and whatnot. So we appreciate regulations, and I completely agree. You should do it right from the get-go, because you don't want to be stuck in a fight with the authorities when you want to do business, really. Yeah? But also, we would appreciate some guidance here. What has to be observed? Yeah? Because for me, actually, being from Europe, it's really hard to find even out what is applicable. So an agency that would help actually startups in this regard might be a good idea, just food for thought. Money laundering. Of course, very important. Yeah, that is, has to be avoided at all costs, because we don't want to be part of a criminal system, of course. That, however, is a problem for any business, yeah, because everywhere you exchange money, money laundering is an issue. So it's just the cost of business. Regulations and compliance. Yeah, compliance, Dodd-Frank. In Germany, banks actually don't want to do business with Americans anymore. And even not people that actually live in America. As soon as you're an American taxpayer, you find only few banks, and if you find them, they charge a healthy fee. So that's a problem. Then you have in the US specifics, federal law versus state law. I learned recently you can smoke marijuana here in the state of California. However, if you sell it, and the feds can actually come down on you, because based on federal law, it's a federal offense. Yeah? So there is a conflict of law, of course, one of the challenges. And now I come to my personal concerns. I actually believe privacy will decrease even more. I mean, everybody knows now where you are. If you download an app, some apps you can only use if you give them access to your contact list. Amazon, for instance, why does Amazon need to know whom I know? And I also read, and I'm not sure it's true, but I am actually pretty sure it is, yeah, if you actually buy on Amazon, once they know your zip code, your price may vary from another zip code. Yeah? So they use actually data mining, and your spending patterns are analyzed. Yeah? And that is something, yeah, what you mentioned, health insurance. Yeah? I mean, they will know how much whiskey you buy, or what you smoke, what you eat. Yeah? There is no way to avoid it if we don't watch it. And Your health insurance will know how much junk food or fruit you consume. Uncle Sam will be able to see how much you shopped outside state, and did you report it on your state income tax return. In Europe, deficits are so high that I actually believe that one day the governments will levy a special tax to just get rid of the debt, because frankly, in my opinion, there is no way they are able to repay it. Yeah? And there are examples. Yeah? I was born after World War II, but I remember when I worked, there was a special tax in Germany after the war. And for those who like to play Scrabble, listen to this word. It was called Lastenausgleichsabgabe. And the law was Lastenausgleichsgabengesetz, even better. But what it said was actually, based on the value of your assets in 1948, you had to pay a 50% one-time tax over 30 years. And if any government gets rid of cash and decides, actually, they want to levy such a tax, they just take it from a bank account. They cannot go under your mattress and get it there, yeah? Now, if your cash is there. But they can get into your bank account. In Europe, we have already banks that charge negative interest rates also to consumers, not only to companies. And so there are concerns with digital currency. However, I believe that's the future. And to show you how this works, actually, Steve and I will transfer a little money here. So let's see, I'll give you this one.
So one part of this is anonymous. I don't know Peter, he doesn't know me, and I don't give up any knowledge about who I am.
And so you see, these are different phones. This is an iPhone, this is an Android phone, because it works platform, platform. And so do you want to receive money or send money?
Receive.
Okay. Then hit receive and I hit send. How much do you want? No more than $100. Oh, you actually want?
It's an iPhone, it's like black top.
So how much?
$100.
$100. Okay, let's see, $100. Okay, what is it for? A test?
Coffee at Starbucks.
And now I say send, and now it says shake your phone, and I shake my phone. We did this just for fun. And it asked me for a code. Do you have a code?
7765.
7765. I put it in and say done. Continue. It says complete. How much did you get?
$100.
See, complete.
Yes.
Okay. Thank you very much.
Yes.
Oh, I want my phone back.
So we have a little time for Q&A, and I can see Bob is already with the first question. So we'll get you a microphone. Just wait a second. And then Dave is second.
I just wanted to make a comment on Amazon. I know an individual who's a mathematician, has a private company, buys and sells goods on Amazon, and does $25 million a year with a 20% profit margin, and has 80 employees, and all they do is they buy in one zip code and they sell in another. So if you live in 92037 La Jolla, and I live in, I don't know, outback Buffalo, Oklahoma, I bet you I get a much lower price than you get. And they buy it and then resell it right on Amazon. Yeah. And one of their major sources is when a merchant comes on and establishes a big program at a big discount, they will go in and they will buy $1 million, $1.5 million worth of the product and then resell it to other places on Amazon. So it does happen.
Yeah.
The digital age.
That was great, and for those of you who don't know, that was Bob Doty. And then I think Bob Goodchild had a question, and then Dave had a question. And then you're up.
Oh, I do have a question. I thought
You
I
have the
was
mic?
next. No,
Like Ronald Reagan said, you bought the mic.
I have the mic. Bob, David Burson, Nationwide Insurance. Given that national insurance companies already have relationships with 50 state DOIs. What are the benefits to the insurance company of InsureCard? I can see what the benefits could be for the individual who would get the card, but what does the insurance company get?
They don't today. They have relationships with them, but they would have to go to each of them and get that information. In some cases it's a statute. But aside from that, they would have to get an approval. So we deal with AmTrust and with AIG. We've gone nationwide companies who have vetted these because it would take them a long time to do it themselves. I mean, the original piece that we did was for Zurich, and they decided it would be 18 months. Am I missing the point? I'm sorry.
What is the benefit of the debit card format insurance company?
Oh.
What you're providing?
Oh, okay. I mean, it's less expensive per payment than a stamp. But beyond that, they all, aside from sending the card out to, say, an injured worker, after that, they all arrive on time. You load the payments this morning, and the payment hits their bank account this afternoon, the one that we established for them. There's voids and escheatment and all those pieces that I've mentioned, but the actual biggest savings is the "where's my check" call, because you send it out and there's so many late pieces to it. Now that's the injured worker side. The medical side, we do that for, I mentioned, we do that. That's a cost to the doctor, not to the insurance company. So whatever that cost is today, we take that away, except for the cost of moving the data to us.
So we have a question from Bob Goodchild.
I'm from SD Sarah. My question is to Peter. What is the difference between your company and, say, PayPal, Apple iPay, and Google is now getting into this field as well?
The difference is actually that we do proximity payments, so you can actually use your phone, your person to person, and it's instantly. And our default is actually anonymous, yeah. So actually, you don't need to know your counterpart. Yeah. Initially, we had the idea actually to tip people, yeah. And so when you traveled, you didn't want to make a bank transfer or wire to tip $1 or $2, but you don't have cash, so you wanted to tip a guy, and you can do it by phone. And the recipient doesn't even need an account, because if the person doesn't have an account with us, they get a QR code with a link, and then they can open the account by just putting in email address and phone number, and then they can redeem the code. Yeah, that's a major difference. Yeah, because all the others, yeah, they claim to be instants, but they are more or less only an intermediary between banks. Yeah, and you need to know the bank account information. You need to have a bank account, and it takes a while. Yeah, whoever used PayPal, it takes 2 or 3 days to receive the money. Here you saw it was under a second. Yeah.
John.
John Calverley. I'm just wondering what the future of the big credit card companies is in this world. I mean, is the credit card model going to survive, or is it that they have the brand names that they can put to these other payment mechanisms, or are they facing a Kodak moment at some point?
Is it a question for me or for her?
And I'm going to ask for really short answers.
I think for me it's very risky to answer a question like this because I'm not paid by any of the card company right now. But I think if you see the future trends or just the current trends, what's happening now, that a lot of segments of the population are looking for to avoid the payments using the current systems, meaning that if there is a service provider in the market who doesn't require you to use a card because it's faster and cheaper and it's free and it's instant, I think in 20 years, maybe the credit card company is going to be also disappearing. But this is just my opinion.
On these systems, are they credit? I mean, these are quick transactions. They're not credit that is.
But in our system, there is also, we developed it because, as I said, we are former bankers, so we have products ready to launch, like personal credit, mortgage loan, auto loan, you name it, which is available right now. So,
So John, I think a technical answer may be, they might be toast. or they get into the business, because the technology is so overwhelming. Well, I'll tell you, we're going to go to one more question, and it was Manuel who I saw, so he gets to ask it.
Actually, mine is very short, and it could be for any of you, but for example, for you, the transaction that you made, you talked a lot about money laundering during your talk, right? Like 500 bills are gone in Europe, or 100. Actually, this makes it much easier, right? I just transfer $500, 100, whatever, to him, and you know, I don't have to pay VAT or anything. He just gives me the money back. It's just a transfer. Therefore, actually, it's making black market much easier and international, because I can do that, you know, proximity international, which is harder to track unless all the data is transferred to some type of regulator, and then I don't know whether I like that. So.
Yeah, but the thing is, I mean, the parties don't know, but we know, of course. We have to, yeah, because, I mean, we have to record it and reconcile. So basically, I mean, when I say anonymous, it's only the parties don't know who they are. We know, of course, yeah, and the government will actually audit these things, yeah, because we have to prove the money is there, where did it go, and you record your business just as anybody else. So, I mean, there will be no black market anymore in the future.
So I'll add
or
to
a little one.
I'll add to that, and I'll take the moderator's prerogative to ask a final question, which I will leave for the next two panels, but I think they've been set up nicely here. So in going through with Peter, and it would be an entire presentation, we went through that they actually use the blockchain technology to record everything. So it's actually there, they have it. And so that brings me to my moderator's question that I'm hopeful the other two panels tackle, and also we can ask Peter and Livia. When they think of these new systems, we know how they're handled in InsureCard. And here's the question, and I'll do it with a little story. So to President Harker's point, when it gets difficult, and so I'm going to take you back to 2008, and the crisis, in the room is David Weska, who at the time was the CEO of SD Sarah, and currently SD SURS, which is the city pension plan. Currently the CEO of the county pension plan. And the great story is, too, is this, Liza and Amanda who worked for him. So he comes in Tuesday morning, and his first words were, "Where is our money?" So the question I'm going to have to leave on the table is, how do I get my money into their system? How do I know it's there in difficult times? And how do I get it out? And I think as we go through the next two panels, I can see Jamie, and so that's the question I'm going to leave. And please thank everybody here. That was great. And we have no break, so if you get thirsty or hungry, it's in the back.
Thank you, Steve. While we're getting our panelists up, the previous section provided a very good segue into a number of the issues that we're going to address at this panel. Moneyness, really. What actually gives these currencies the attributes of money, and what do they have and what don't they have? And more importantly, is there anything new here in reality? And so, you know, we've talked a little bit about payment system issues. And what I wanted to do here is to put up a list of various kinds of payment mechanisms that presently exist. And everything from cash, of course, which I don't have on this list, to credit cards, debit cards, traveler's checks. We've got large dollar payments from the Fed. We've got electronic securities, so securities are changing hands electronically. We have both international activities, message systems with SWIFT, and we've got PayPal. Bitcoin, there's some on the order. I found a list of approximately 72 different cryptocurrencies that are presently in the various stages of development and deployment. And then there are ones that we've talked about before, Apple Pay, Google Wallet, gift card. I mean, there's a whole wide range of payment mechanisms that exist. But what I wanted to talk about just for a second is what gives some of these instruments their moneyness. Of course, if you go back to the textbook kinds of definitions, we know medium exchange, store of value, unit of account, and so on and so forth. But what I think is sort of interesting about a number of these different mechanisms is how the clearance, settlement, and transactions actually differ across these various instruments. Let me give you an example. Cash, for example, you make a cash payment, you go, it's cleared, settled, and you got your good right in your hand. In the case of a credit card's different than a debit card. In the case of a credit card, you make the transaction, you settle, it clears, you settle at a later time, and actually you have an option. You have an option to pay immediately, or you can incur a credit charge. So there's other features associated with that particular mechanism that doesn't necessarily exist with the others. In the case of a debit card, you make your transaction, and it clears and settles electronically down the road. In the case of a traveler's check, which probably you don't really think about, traveler's check, you settle first with the company, then maybe make a decision to spend it, and then it clears down the road. And of course, then PayPal has come along with a little bit of a different wrinkle on that, because they step in the middle so that you're protected from information flowing from the seller of the good to you, but you actually can have the option now of deferring payment until you actually receive the good, and they monitor whether you receive the good. So there's a whole range of different attributes that all these financial instruments actually have. And so we're going to take a step backwards in history here a little bit, and Warren's going to talk to us about what some of the moneyness features and issues were in past history and how they translate into where we are today. And then Rod Garrett is going to talk a little bit more in detail about some of the cryptocurrency. So with that, turn the floor over to Warren.
First of all, let me just say it's great to be here, and I want to thank Dave Altig for the invitation to be on this panel. It's caused me to do a lot of thinking about means of payment and what we can learn from history. Could I have my slides? Aha. Finally. I have to start with a disclaimer, since I did a lot of this work for the Bank of Canada. A lot of what I'm going to talk about today is based on that. I need to make sure you know that none of these opinions are theirs, and since I used to work for the Federal Reserve Bank of Minneapolis, and I'm now a visiting scholar at the Federal Reserve Bank of Atlanta, I also better disclaim that the Federal Reserve System and those banks have no responsibility for any of my outrageous opinions. So, there's already been talked about, but there are movements in many countries right now to go cashless. We see that, I can't even read my slide. In Sweden, many banks do not, let's put it out here, do not have any cash on hand. They don't take cash for deposits. In Korea, they say they're going to try to go cashless by 2020. Some Asian countries, in India, and Jamie McAndrews has told me I'm wrong in terms of they're getting rid of large denominations, at least in India, but there are other Asian countries doing that. And as has been talked about here, there is the movement in the United States to try to get rid of $100 bills. So as cash tends to go away, something's going to have to replace it. Some possibilities are checks, debit cards, credit cards, and what I want to talk about is digital currency. So you might think that, digital currency is relatively new. What can history teach us about it? But I think if I had to put a subtitle on my talk, Patrick, I would put on that everything new is actually something old. And so I'm going to argue that there are financial instruments in the past that really have most of the important characteristics of digital currencies. And these are the notes issued by banks and governments. And I've underlined banks because I will actually spend most of my time talking about banks, talking about bank notes. And so what I really want to do is take the experience, the historical experience from Canada and the United States, and see what lessons I can draw from that about what might happen with digital currencies. Oops. Okay. So I'm not sure that everybody's familiar with the history going all the way back into the 1800s, so I thought I'd do about a 2-second little primer on that. In the United States, state banks, and by state banks what I mean is banks that had a charter from a state. These are single brick and mortar entities in almost all cases, okay? They started issuing notes way back in 1786 and continued to issue notes. The state banks continued to issue notes until about 1866 when the government decided they would tax them out of existence. They taxed them out of existence because they wanted notes to be issued by national banks. Now, national banks were not national in any sense other than the fact that they had a charter from the comptroller of the currency. They had a federal charter. I remember growing up in Evanston, Illinois, and my parents banked at the State Bank of Evanston, which was a state-regulated bank, and across the street was the National Bank of First National Bank of Evanston, okay, which had a different charter, okay. Don't ask me why my parents picked the one they did. But anyway, these national banks started issuing notes really in 1863 and continued to do it all the way up until 1934. In Canada, chartered banks started issuing notes in 1817 and did it all the way up until about 1944, okay? Governments actually got into the note issuing business late. And given one of Steve's questions about do you have to have a central bank to run a payment system, I think if you look at history, the answer to that is definitely no, you do not. As you can see, the Federal Reserve System, which started in 1913 when it issued notes, but so the United States until 1913 did not have a central bank. Canada was even slower. They didn't get a central bank until 1935. When it started issuing notes, although the government of Canada actually got into the note issuing business as early as 1864. Okay, so what do I mean by digital currency? I'm sure everybody in this room thinks they know. I just want to be sure that we all have kind of the same definition. So it's something that has monetary value, it's stored electronically, and this to me is kind of the critical one, whose use is neither based on nor requires funds in a deposit or credit account in a financial institution. Now, I'm not saying that digital currencies can't be issued by a financial institution, but they just can't be linked to an account in that institution. They also are supposed to be widely accepted as a means of payment. So, what I'm including in my definition of a digital currency are things like prepaid cards, and tokens such as Bitcoin, if they happen to be widely circulated. I am excluding debit cards, credit cards, and gift cards. Debit cards, you have an account. Credit cards, you have an account. Gift cards, they're really not widely accepted. They're pretty much tied to one particular merchant. Okay, now, let me try to convince you that these banknotes, and I'll pretty much do it on the state banknotes, were like digital currencies. This one is for Steve because we were talking last night. Did you get the denomination on this one? There were actually 6 banks in New York for a while that issued notes with denominations of $11, $12, $13, and $14, okay? I have another one here. This is from a town in Minnesota, Austin, Minnesota. You ever heard of Spam? That's where it comes from. And again, I thought you might like to see another cute little denomination there of $3, okay? These are actual notes from the time. This one's from about 1857. Why do I want to claim they're kind of like digital currency? Well, take a look. First of all, there's monetary value. See the $3. There's no connection to any account. If you go back and look here, what you see is that it will pay $3 to the bearer. To the bearer. It doesn't say that guy who, put $3 in the bank to get the note, the guy who came in and took the loan. It doesn't say somebody who lives in Austin, Minnesota. It doesn't say anything like that. It just says, you have it, fine, you come and see us. We will give you $3 in specie. By the way, specie is gold and silver coin. That's a technical old, if you're a monetary historian, you better know that word. Okay, so was it widely accepted? You can't see it from my picture. Trust me, it was, and I'll try to give you some evidence down the road that it was widely accepted. It's certainly been accepted everywhere in Austin, Minnesota, probably all the way up to St. Paul, Minneapolis, other cities in Minnesota. And, well, I'll tell you what would have happened if you took it to New York City in a minute, okay? Now, the problem is, though, that it wasn't stored electronically. But what I want to argue, and I want to, that everything new is really something old, is that, look, I think I've pretty much told you it's got monetary value. It's not related to any account. The only real difference is that this value is stored on a piece of paper rather than being stored electronically or on some kind of electronic device. So if you're willing to accept that, I can move on and try to give you some lessons that I think we can see about digital currencies today, given what happened with these banknotes. So the first one, I think, is that you could have digital currencies issued by the government and issued by private entities, banks, I don't care, any kind of entity that's doing it, that they could exist at the same time. They can all be out there, okay? And I don't think that just the fact that the government might start to issue digital currencies is going to drive these bank or whatever you want to call them, currencies out, okay? That really what it's going to take to drive out these private digital currencies, if the government wants it to be the only one, is you're going to need some kind of government prohibition, okay? Now, if you first look at my slide here, you might think, hey, he's nuts, okay? Well, half nuts. You can see the period in which there was simultaneous circulation. The national bank notes and Federal Reserve notes both were in circulation between about 1913 and 1933. You've got 20 years in which they actually circulated. In Canada, you've got the period from like 1864 to about 1944, about 80 years in which these things circulated side by side. So we've got periods in which they both circulated. But you look at my picture and you say, hey, but at the end, the only things left were Federal Reserve notes and Bank of Canada notes. So didn't eventually those things get driven out? Okay? Well, my answer is no, they didn't really get driven out. What happened is they got legislated out. What happened in the United States is that the United States Treasury basically said, hey, you know all those bonds that you as a national bank have to back your notes? Guess what? They're gone, okay? National banks could no longer issue notes. As an aside, if you take a look at it, though, I don't remember the exact date, but the law was changed in the United States. Actually, banks could now go ahead and start issuing notes. So it is kind of interesting that banks have not started to issue notes again, although I think it would be very costly for them to do it, and that's probably the reason. In Canada, basically what happened is in 1944, they just basically said flat out, banks, you can no longer issue notes. Okay? So the reason there are no bank notes right now in the United States and Canada, I would argue, or why they disappeared in those two countries, I would argue, is that the government basically said, they're gone. Okay, my second lesson is that private digital currencies generally will not be safe unless there's some kind of government intervention. All right, here's my evidence about what happened with banknotes. In the United States, state banknotes were not safe, and some note holders really suffered losses. If you take the period from 1786 to 1860, at one time or another, 2,384 banks were in existence, okay? I've actually gone in and I have checked, and I believe that number is accurate, okay? And I've actually got a paper written where I tried to demonstrate that. Now, they weren't all in business at the same time, but there was a time, let's say, in the late 1850s, when there were about 1,200 banks in existence, state banks in existence in the United States. Each one of those banks was issuing its own notes. So if you were alive at that time, you could potentially have been dealing with 1,200 different currencies. Well, I mean, right now, today, you realize that you're actually dealing with 12 different currencies, all right? Each Federal Reserve is actually issuing its own notes. And if you remember a few years back, it was actually quite prominent as to which one was issuing it. They've taken that away, okay? So you're, and they made sure that it doesn't make any difference which one you have. You can take a Minneapolis Fed note into Patrick's Bank, and they'll give you one of theirs, and, absolutely fine. But anyway, but back then, it was kind of interesting. Now, of those 2,384 banks, 407, that's probably an upper estimate, but 407 of those banks failed with losses to note holders, okay? There were a large number of other banks that sort of went out of business and nobody lost. Well, at least note holders didn't lose, okay? But here, basically, 1 out of 6 of those banks that started went out of business and somebody lost. And when you take a look at the losses there, they were somewhere between 3 cents on the dollar and 96 cents on the dollar. That's the highest I've been able to find, okay? Now, Canada was better. Canada's banks were safer. If I look at the period up to 1890, okay, 1867, 1890, 55 different banks were in business in Canada, and only 3 of them failed, okay? So they were much better at their banks staying in business. However, if you happened to find one of those failed banks, you took a big hit. You either lost 40 cents on the dollar, 42 cents on the dollar, or there was one bank where if you had one of their notes, totally worthless. You got nothing back. You lost everything. Okay. But government intervention in both countries made these banknotes safe. In the United States, remember I have those state banks and the national banks, there were no losses to anyone who held national banknotes. The reason? The government insured national banknotes. Basically, there was the Federal National Bank Insurance Corporation. It was called the U.S. Treasury. The U.S. Treasury said, your bank fails and it can't go and pay off its notes from its assets. Oh, and by the way, national banks also had what's called double liability, so they could also go after the shareholders up to the amount of their stock. And if we can't get it all back when we go after the shareholders, we, the Treasury of the United States, will make good, okay? I think there were a couple instances where they actually had to, all right? In Canada, there were no losses to banks after 1890. And what happened there was in 1890, they passed a law that basically set up something called the Bank Circulation Redemption Fund, and it said they would pay off all the losses to note holders. Now, what is interesting about that fund, though, is it was not government insured. There was no government liability underneath that one. This was just the banks were forced to contribute to some, basically contribute specie, gold and silver, to the Canadian Treasury. And it was there to pay off the notes of any bank that happened to fail after that. Fortunately, I guess for Canada, they never had a big number of bank failures that depleted that fund, but it did act to make banknotes safer in Canada, in my opinion, anyway. So my third lesson is that private digital currencies with the same monetary unit, so I'm talking about digital currencies all denominated in dollars, okay, something like that, they will likely not exchange at par, but government intervention can lead to par exchange. By par exchange, think of uniform currency. That means, a dollar is a dollar is a dollar everywhere, okay? Now, in the U.S., these state banknotes, those notes early on before the Civil War, basically did not exchange at par in general, at least certainly not outside the local area. Virtually every major city had a publication put out by a note broker that was called a banknote reporter. In a lot of cases, it was also called a banknote reporter and counterfeit detector because counterfeiting of these state banknotes was actually rampant. But I don't want to get into that, okay? what these banknote reporters did is they listed the discounts in that city of the notes of all banks in the country. So you get to one of these in the 1850s, and basically you've got a listing of about 1,200 banks in this publication. Give you some idea. Here's one from a banknote reporter in New York City. It's from January 1st of 1854, and it's for banks in Pennsylvania. You probably might have a little bit of trouble reading it, but what it says is that the Anthracite Bank in Tamaqua, Pennsylvania, don't ask me where it is, okay, they would go at a 1/4% discount. If you happen to walk in there with notes from the Bank of Chambersburg, you would take a 1% discount. Now, you're all probably wondering, or you probably know geography well enough to know that Allentown isn't that close to New York City. Why were its notes going at par? Basically, it says, okay, you bring the notes in this brokerage and we'll give you notes of a New York bank, 1 for 1. Why? Because the Allentown Bank said, we will set up an account with some banks in New York that will actually redeem the notes 1 for 1. And by doing that, they basically guaranteed that their notes would go at par. Okay, what about Canada? Canada had the same problem. Canada also found that notes from different locations would not exchange at par in other locations, okay? So what did they do to make this work, okay? Well, there's a couple of government interventions. If you take a look at it, national banknotes always did exchange at par. Why? Because the United States Treasury in 1872 set up an institution that said, if you're a bank and you get the notes of some other bank, bring them into us and we will give you specie in the same value that you brought in those notes. So basically the banks didn't lose anything by taking the notes of some other bank, so why not take them at par, okay? In Canada, banknotes exchanged at par starting in 1890. That same act that set up that bank circulation redemption fund, this was a big act in Canada in 1890. Also basically said a bank, if you're going to issue notes, you have to set up a redemption center in all of the major commercial centers of our country. So now you have the notes and you're out somewhere in the sticks of Canada and you go to Montreal, okay, you will find a redemption, a place that will redeem those notes at par, okay, for you in Montreal. So that basically got rid of the discounts on banknotes in Canada, okay? So, what a point I want to make, though, is that in both cases, it actually took some form of government intervention that private mechanisms never arose. Now, Bob was nice enough to pull something that he wanted to talk about. There was actually one little footnote that I need to put in here, which is that there was, for a time in New England, from about 1827 to 1857, something called the Suffolk banking system, where one bank in New England, the Suffolk Bank, okay, said basically, you make a deposit of specie with us, okay, and we will basically trade your notes at par with anybody else who has a specie deposit with us. So they basically set up a par clearing mechanism. And if you go in and take a look at the banknote reporters during that period, you will find that all of the notes of New England banks were, if I was looking at one from Boston, it would say they're all at par for all the New England banks. Or if I took one from New York, I'd find that every bank in Massachusetts, Vermont, New Hampshire, and Maine, all of those banks were going at exactly the same discount. The only exception was there were some banks way up in Maine who did more business with Canada than they did with the US, and their notes were going at a big discount, but other than that, they all went at par. But that's the only private mechanism. And one thing that's always bothered me is why weren't, I mean, Suffolk Bank made a heck of a lot of money. It was the most profitable bank in New England during that whole period of time. They were making a bundle off of setting up that system. Why didn't it appear anywhere else in the United States? So it has to be very hard to set up that kind of private system, in my opinion anyway. Okay, so to summarize, my lessons from history, private and government digital currencies can coexist, and government currencies aren't going to drive them out unless basically the government prohibits them. Private digital currencies generally will not be safe without some kind of government intervention. It doesn't necessarily have to be government insurance, but the government's got to get in there somehow. and private digital currencies with the same monetary unit, and again, it's important to me that it's the same monetary unit, so it's dollars, dollars. I'm not saying that, I'm not talking about the exchange between, let's say, dollars and Bitcoin, okay? That they will not generally exchange at par either, but government intervention can lead to par exchange, which leads me to follow up on some of the last panel. If you think about it for a minute, paper currencies are dumb, okay? They carry no information other than this person's got it in their hand. But you go to a digital currency, and we were talking about Amazon and the discounts, digital currencies can carry information like your zip code, or where you shop, or the name of a store, or the name of a good, or the name of that. It can all be in those digital currencies, which means that you could have discounts or premia, or you could face different prices depending upon where you are or what you're buying, okay? And the price you pay might be different than someone else, okay? Do we see that today? Sure we do. Loyalty point programs for your credit card, okay? So, you know, you're getting a different price. Or just look at the interchange fees. Merchants are not getting $1 for every dollar that you happen to be paying. So this is not particularly strange. I was told that these are question and answer sessions, so I thought I would put up some questions, all right? And some answers, okay? So, will governments insure at least some private digital currencies? And I think the answer to that is absolutely yes, and that's because governments cannot credibly commit not to. If you've got a big issuer of digital currency and it goes belly up, you can know what's going to happen with the amount of pressure that's going to be put on the government or the Federal Reserve System to step in there and make everybody whole. So I think that, you know, will these things be insured? I think the answer is yes. Okay. Will central banks issue digital currencies? Here, Patrick, I have to disagree. I think they will, especially once they start trying to, or once cash starts to disappear. Central banks need seigniorage revenue. As a matter of fact, I hope they keep a lot of seigniorage revenue because I'd like them to remain independent. I don't want them to become, you know, agencies of the government, okay? I want them to be independent. I want them to have seigniorage revenue. And if they start losing it, I hope they start issuing digital currencies. I think they are going to start losing it from currency, so I think this is going to happen. Okay, will there be digital currencies while alternative monetary units? I don't know, okay? There's Bitcoin out there. Is it widely accepted? We can get into arguments about that. Yes, I know there are now BTMs out there. There are Bitcoin teller machines in some places, but most of them are only like one way. You can put in your dollars and get your Bitcoin, but you can't put in your Bitcoin and get dollars, okay? So I don't know about that, all right? But one thing I think, and my major takeaway would be, if history teaches us anything, it's that means of payment are going to evolve and adapt over time. There are going to be new means of payment coming in the future. They may look somewhat like the old stuff, so I agree with you there, but there's going to be new stuff down the future, okay? Thank you.
Thank you, Warren. Rod will now take us back to the future.
I'll wait for the slides, but in the meantime, I'll thank David Altig as well for inviting me. It's a pleasure to be here. I just drove up from Santa Barbara today, so it wasn't too long of a journey, but it was raining. So what I'm going to speak to you about today is this question of what is a CBDC, and this question appears a lot. So we've been talking a little bit about digital currencies, and when you throw CB in front of it, we're talking about central bank digital currency. And Warren just raised the question, and we heard it before, whether or not we'll see one in the future. And I can tell you that I'm working on multiple projects to build them. So I think the answer to that is pretty definitively yes. It's just a matter of timing. I should say that I came here from the University of California, Santa Barbara. I also work for a firm called R3, and maybe move to the next slide. So, oh, I have a clicker, I'm sorry. So the first thing I thought about when talking about this is that there's a lot of terms that have been floating around. And I worked on one of these Basel working groups to discuss virtual currencies when they came out. And there are these terms, e-money, e-cash, digital money, electronic money, virtual currency. And these all predate cryptocurrencies. In particular, even the virtual currency term was around in the context of these games like World of Warcraft. So these terms have been around a long time. And it's also the case that most money is digital. So around 40, a recent Fed survey of consumer payments showed that around 40% of payments are in cash and 14% of value. But that means that the remaining, the bulk of payments are done in some digital form. We have bank deposits, reserve balances at Federal Reserve banks, and as people have been talking about today, cash on prepaid cards. So the word digital doesn't denote much that is special or unique to this current situation either. So if we want to think about CBDCs, we have to think about something else in terms of defining characteristics. And this isn't so much as a definition, but I think one of the key distinguishing features is that they're digital entries representing central bank money. And that, by the way, that's important, that whether or not we're actually talking about central bank money. A lot of these digital currencies that we've been talking about, Bitcoin, aren't central bank money, and so it's quite a different animal or innovation to think about central bank money, or at the very least claims to central bank money that exist off of the central bank's balance sheet. Now, I realized when I wrote that there's an implication there that I don't want you to have. This doesn't mean that the aggregate amounts of the central bank money don't exist on the central bank's balance sheet, as they will. They'd be liabilities on that balance sheet. But the key is that these entries in the form of central bank money also exist on other balance sheets, in particular a distributed ledger. And the main implication of this is the idea that transactions can be made, at least in principle, without updating the central bank's balance sheet. Okay, so we can have some liability on the central bank balance sheet which issues a new form of, say, digital token which exists on a distributed ledger, and transactions in that currency can occur on that ledger without perhaps the central bank knowing about it. And that brings us really to the fact that there are really two visions when we think about what a central bank digital currency might be. One vision is the idea of a cash replacement, and that's, I think, what, to a large extent, we've been talking about here today. So Bitcoin is a cash replacement. I'll talk in a minute about a version of Bitcoin that would be tied to the US dollar and implemented in cooperation with the Federal Reserve if it were ever to occur, called FedCoin. But this is a consumer-facing idea of a currency that's a replacement for cash. That's one vision. But a whole other vision is the idea that we might have a central bank digital currency that's used in closed systems. So not open to anyone, essentially something that's happening in the back office, so to speak. And this is what a lot of central banks are actively working on right now, and I'll talk to you a little bit about a project that I'm involved in. But here the idea isn't to replace cash, to change the way that consumers do spending at the retail level, but it's a way to use technology, particularly the distributed ledger technology, in order to try and improve transparency, resiliency, efficiency, and reduce costs in traditional payment platforms. So let me talk a little bit about FedCoin. I don't know, has anyone heard this FedCoin name before? So not too many, okay, a couple. So FedCoin is sort of an interesting character. So this terminology, this idea of FedCoin is, first of all, I should point out that this does not originate with the Federal Reserve System. It's not a Fed proposal. But it originated by a blogger called J.P. Koning, who, first of all, just started about whether or not we could replace FedWire funds, which is the large value payment system in the United States that does about $3 trillion a day in value. Whether or not we could replace this with a distributed ledger technology. But the FedCoin term appears a little bit later. He actually coins this term. And this is the idea of having essentially a Bitcoin type currency that circulates on a distributed ledger, but is tied one for one with the US dollar. So the idea would be that consumers, currently you have an option of having cash or you have deposits in your bank account. And the idea is that you would go to your branch bank and say, I'd like to actually transfer some of my deposits, or I'd like to take this $100 bill, and I'd like to have it turned into FedCoin. And you would have this third component of the monetary base, basically, this third way to spend money that would operate on this outside distributed ledger. And this is the proposal. And I should point out that there was a person named Sina Motamedi that proposed something very, very similar in terms of a Bitcoin type coin that's tied one-to-one with the US dollar. But unfortunately, his proposal didn't get much traction. Two things happened with the FedCoin proposal. One is that it was endorsed at a payments conference. And the other thing is that the name just seemed like it was a little bit better than BitDollar, which was the name that was proposed in the other proposal. So as I mentioned, the key thing in thinking about what FedCoin is to understand that what this is doing is it's emphasizing Bitcoin as product over Bitcoin as philosophy. So if you recall when Bitcoin came out, the idea is really sort of a countercultural idea, a libertarian notion of creating a currency that isn't under the control of the government. There was lots of things that were occurring at the time that made people think that this might be an important idea. And so in some sense, when Koning proposed the FedCoin idea, it was really bucking against this trend, because here he's talking about something that almost seems antithetical to the main idea of Bitcoin, which is to have a Bitcoin that's run by the federal government. It seems it sounds illogical in some sense. But of course, the idea again is that he's emphasizing that we're just trying to make a better payment instrument. He's not trying to sort of have a cultural revolution. There's nothing political about it. He's not worried about the role of the government in the system. He just wants a better payment instrument. And this is the idea that underlined the FedCoin proposal. And the reason for tying it to the US dollar, the special role that the central bank plays in the FedCoin proposal, is price stability. So as other people have mentioned, no one's shown you a chart, but the price of Bitcoin fluctuates. Price of Bitcoin in terms of the exchange rate with other currencies, particularly the US dollar, fluctuates wildly. And so people would be hesitant to hold it. And so one way to make this stable is, as we've talked about, is to tie it one-to-one with the US dollar. So that would be the primary role of the central bank. So there is an interesting issue that comes up, and Warren touched on this, and this has been discussed by monetary economists for years, is this idea of two-way convertibility. If you have one currency that's tied one-to-one with another currency, say particularly the US dollar, then the person who's supplying that alternative currency would simply increase its supply in an unlimited amount, which would, of course, cause the system to collapse. And so that can't work. And so if you're going to have another currency out there with a fixed exchange rate, then what you need to do is you need to have a gatekeeper. And so that's what the role the Fed plays in this. This alternative currency, FedCoin, can't just be created out of thin air. It's only created by the Fed when someone surrenders either deposits or cash. And that's how the money supply is controlled, and that's how the one-to-one convertibility can be maintained. There's a literature on paper, a wide literature of papers that discuss what the issues are in having competing currencies and two-way convertibility. I list a few of the papers there. But what this really means, by the way, is that the FedCoin proposal isn't really about a competing currency. It's really just an alternative form of sovereign currency. So very, very distinct and different in a way than the Bitcoin proposal, even though it shares a name that's very similar and an underlying technology that is very similar. So as I said, with Bitcoin, what we would really be doing is we'd be expanding the monetary base. We would have cash, reserves, and FedCoin. And there are a vast array of monetary policy issues that come into play if one were to do this. One of the main, there's this idea of having different ways to implement monetary policy, the possibility of negative interest rates, which other people will talk about later. But another thing that this would do, if you think about yourself as a consumer and having the ability to move your holdings of, say, cash from deposits into FedCoin, is that if FedCoin would be basically, even though it's transacted on these distributed ledgers, it would still, as I said, be a liability of the central bank. And the central bank holds high-quality assets, so as opposed to consumer loans, like regular banks. So we don't have this risk and maturity problem that's associated with deposits. And so this would essentially be a system that is supported by basically the narrow banking idea. So not unlike Tobin's deposit currency accounts, or a proposal that was floated by the New York Fed a couple of years ago to have, well, Jamie McAndrew's proposal to have segregated balance accounts. But now let me move on to the other vision, and then we can maybe talk about contrasting the two. This was a presentation, a slide from a presentation that was given at the Payments Panorama Conference in Calgary last year. This session was closed to the press, but this picture was taken with a cell phone and sent to, so talk about modern technology. Closed to the press is kind of almost, it's just almost like you're joking. This is a proposal by the Bank of Canada in cooperation with a number of private Canadian banks and a company, R3, which is a company that helps facilitate this type of cooperation, to create a Canadian digital currency for large value payments. This would operate on a closed system, so it's not like FedCoin, it's not consumer facing, but merely an alternative way to do large value payments. I should mention one kind of fun fact about this slide is that the person that took this slide and released it to the press, this is actually taken from Forbes' website, was a guy named Kyle Kemper, who's the half-brother of the current Prime Minister of Canada, Justin Trudeau. So the idea of CADcoin that you can see from this slide, and everything I'm going to say about this project is public. There was, of course, after the plan at the Bank of Canada was to do a speech announcing what this was all about after the fact. They probably had the cart before the horse on that one. But this slide tells you basically what the key elements were. So the idea here, the way this system would work, is that Canadian banks would send money to the central bank. So they would make, in what Canada's called a real-time gross settlement, a tranche one payment. So they would send a payment of money to the central bank, and the central bank would keep this money in a pot, so to speak, a digital pot, but a pot nonetheless, and then they would issue an equivalent amount of digital currency. At the time, they used the word CADcoin. That's what appeared in these slides, but that created too many associations with FedCoin and so on, so I think they're backing away from that. But the idea is that once they've pledged this money, they get issued, just say digital tokens on this distributed ledger, and then they can make their payments throughout the day with these tokens. So these can exchange on the distributed ledger. The validation and verifying transactions are valid, making sure people have the money in account, confirming that there's no double spending. This can all be done by the type of protocols that are used on distributed ledgers. Not a proof of work blockchain protocol like underpins Bitcoin, but more modern consensus algorithms that actually allow the central bank to play a role. Because one of the key things here, and I'll get to this, I guess, in some later slides, is that what's funny in this development of technology is you start off with something like Bitcoin that's designed to be censorship resistant. It's designed to be trustless, but it has a whole bunch of baggage that goes along with creating those characteristics. In particular, this proof of work idea, which is highly computationally intensive, uses up hundreds of thousands of dollars in electricity every day, and it's all designed to create one thing that you don't need in a closed system, which you don't need it to be trustless. You're willing to have the central bank play a key role. So the idea here is to move away, in a large extent, from those aspects, but preserve the features of the distributed ledger that are beneficial. The idea that the system is distributed, it exists everywhere, it's resilient, you have real-time updating, it's transparent, or as transparent as you want it to be. It doesn't have to be fully transparent. There are many characteristics, including the fact that you can run smart contracts on the distributed ledger, so you can have the automatic implementation of contracts. If you thought about something like a coupon bond, okay, you could have a smart contract that would allow the coupon payments to be executed automatically. There's just an unlimited number of potential for what you can do on these distributed ledgers. But what you don't need to do is worry about trustlessness or trust and censorship. And so these move away from those concepts and allow these systems to function more clearly. So the central bank has a role in these systems. Of course, it has to have a role. It's the payment system. It's a supervisor. It has to be able to see the payments. But it can also play a role in validating transactions. So the idea is the central bank gets the money. It issues these tokens on the ledger. And these tokens are exchanged throughout the day by participants. Then at the end of the day, these tokens are paid back on the ledger to the central bank, and then the central bank sends actual cash payments back to the banks. That's assuming you want the day to end. It wouldn't have to, but currently payments days have a beginning and an end. I should point out, as I said, well, I didn't say this yet, but this is not a proposal for a new Canadian money that will exist in the immediate future. This is an experiment. So this is a couple of statements that were made by Carolyn Wilkins, the Senior Deputy Governor for the Bank of Canada, shortly after the Payments Panorama Conference. So this is an experiment they're undertaking. This is confined to interbank payment systems. None of our experiments are ones to develop a central bank issued e-money for use by the general public. So as I said, this is an alternative vision for central bank digital currency, operates in closed permission systems, which is designed to just improve the functioning of payment systems. Technically, what's being transferred on this distributed ledger is a deposit receipt. So what you've done is you've issued a receipt which gives the holder a transferable claim on an asset, which is central bank money held by the central bank. I would argue that that's still a central bank digital currency, and I would even argue, maybe going on a limb here a little bit, that this could be considered inside money since its value is backed by assets on the central bank balance sheet. Now that kind of goes at odds with the standard term for inside money, which is something that's inside the private sector, something that disappears with consolidation of private balance sheets. But it's kind of like the central bank is acting like a private agent here, because it's just basically holding this pot of money on behalf of the system and issuing this asset. It's really not all that different than what we were just talking about with banks having gold and issuing paper certificates that are backed by that gold that the customer can come back and redeem. And those gold certificates would be considered inside money. So that's kind of semantics, but I think it's important for understanding what the central bank is doing. The central bank could do something very different. That is, they could take the money that the banks give them, that the private banks give them at the beginning of the day, and they could destroy that money, and they could issue them tokens on the ledger. But then they'd actually be creating a new money. That really would be a central bank money. This model, while sort of almost, the difference is almost semantic, is quite different in terms of the interpretation, both, I guess, from an economic point of view and from a legal point of view. So what's trading on the ledger are digital tokens, but these things represent claims on central bank money, and therefore themselves are essentially the same as transferring central bank money. As long as one thing is true, and that's that the legal structure is in place that ensure that a transfer of a digital token on the ledger is equivalent to a full and irrevocable transfer of the underlying claim on the central bank. That is, if I start off with $1 million of CAD coin at the beginning of the day, and I send you 50 million, and then I go bankrupt, neither myself nor any of my creditors can come after that 50 million. That 50 million, much like a bearer bond, once it resides at your address in the ledger, that's your 50 million. You come back to the central bank gives you 50 million in central bank money. Again, the creditors can't come after it. A very important thing that still would have to be resolved. So to sum up, FedCoin, CADCoin, two very, very different concepts. Again, emphasizing FedCoin is not a Fed proposal. It was a proposal by a blogger that got some attention. David Endelfato was the one who pointed to some of its merits, and he was is at the St. Louis Fed. That's one of the reasons it got so much attention. CAD coin also is something that is being considered, but again, it's in the experimental phase. It's not a proposal for something that will actually happen immediately, and the CAD coin name is likely to go away. But the idea, again, is that the beauty of thinking about using central bank currencies for large value payments in these closed systems is that you can take the full advantage of distributed ledger technology, smart contracts, and you don't have to be subjected to the burdens of trying to have censorship resistance and trustless systems that are embedded in the idea of Bitcoin. And I would say one more thing, which is that one of the reasons why this proposal for a central bank digital currency on the wholesale side is so attractive is that there's a lot of work that's being done across the industry to think about ways of using this technology. And one of the biggest things that people are working on is thinking about using this technology in a securities clearing and settlement. So the trading of securities is a very complicated thing with many moving parts. There's the person who wants to buy the security. There's the broker that trades. There's the central security depository that holds the securities. Money has to be transferred. SWIFT messages have to be sent. Reconciliation has to occur. Delivery has to occur. There's all kinds of things that have to occur for securities transactions. And so what would be really nice if this could all be done on one big ledger. And that's what the sort of promise holds. But you could do all that in terms of thinking about even having the security itself registered on the ledger. And you could transfer ownership. And you could keep track of who owes what and who owns what. But you can't actually finish the transaction if you can't transfer real value across the ledger. So the central bank digital currency is that final piece that essentially makes clearing and settlements the same thing, makes them simultaneous. And that's one of the things that people are working towards. And the last thing I would say, just a little economics to throw into this, is that much of the technology that's being developed in this sphere is open source technology. And that's a really positive thing because much of what's developed here benefits the whole tech community, the whole fintech community, I guess, to use that word. And there's simple economic arguments on research and development for public goods that say that if firms work on this in isolation, there's a positive externality that they don't internalize and will get underinvestment. And so it's very important that we have mechanisms by which firms can cooperate, central banks can cooperate, not just in terms of internalizing the positive externality, but also for obvious reasons. We want the systems to be interoperable. We want to adopt standard procedures. And of course, there are network effects in the use of these. So right now, we do see a variety of consortiums. This company, R3, is one of them that facilitates this type of exchange. And as I said, much of the work that's being done here is open source, which is very positive. Thank you.
Thank you very much, Rod. We'll open this up for questions. I just want to make a couple observations. First, that what you've described is really not all that different from Fedwire for large dollar payments. And think about it, the Treasury actually could issue infinitely divisible Treasury bonds and allow individuals to transfer them on the securities transfer system. And you've got an interest-bearing government liability that's very close to a lot of what you're talking about. But anyway, Tom?
Well, my question is, thank you. Tom Sinnott, and my question is, don't we really have this with Fed funds transactions between banks?
It's, do I have to turn this on?
No, it's on.
Okay.
Let's just get close.
Yeah, no, well, we have the ability to make payments in real time. So Fedwire is not broke. So I worked with Jamie on that system for years. And there's nothing wrong with Fedwire funds. So this is about coming up with alternative innovations that can maybe do some things better. And so one thing I mentioned was, it's a different type of system. So Fedwire is like a hub and spoke system. So you have a central processor. People communicate to the central processor and have exchanges made, and then messages are sent out. This could, in principle, go down. Hasn't happened to Fedwire, but the large value payment system, CHAPS in the UK, went down for around 8 hours last year. So this system is a distributed system. It operates. It exists everywhere that it's run. So maybe it's more resilient. You have this ability to implement smart contracts. So it's really, and other potential advantages, which would take me more time to go into, but it's not about replacing something that's broken. It's about whether or not this alternative technology can enhance and improve the current way of doing things. And that's why banks are exploring this. And the jury is out. I think I don't know if you're being skeptical, but the jury is out on whether or not this will, people will determine this to be better, but there's enough promise there that central banks around the world are exploring it. But again, it's not to replace something that doesn't work. It's to see if we can create something that has some advantages.
Michael, Drury?
So my understanding is that most of the Bitcoin in the world is in China, and they've been bashing Bitcoin brutally over the last 2 months. And my sources tell me that there was a conference held in January on financial innovation, and that the PBOC will be issuing a digital currency this year. Anybody know anything about this?
All I know is that there are a large number of traders over in China right now that are basically trying to, that are making their money by arbitraging across the various exchanges where Bitcoin is being traded for other currencies, and they seem to be doing very well. I don't know how many exchanges there are that are trading Bitcoin right now, but it's a large enough number that they can make money off of doing that. One thing I have to mention is Bob kind of mentioned that there are like 70 cryptocurrencies out there. Actually, if you take a look at the number, it's about 700 of them. And what I find surprising is right now, a lot of startups are funding themselves through what they call IOCs. These are initial coin offerings, not initial public offerings. And so what they're basically doing is saying, look, send us dollars or send us Bitcoin and we will send you these tokens, okay? You have no equity interest in our firm whatsoever. But, if we happen to do well, they think, or they're trying to get people to believe that then the value of their tokens will go on up. They're also, this is kind of cute, I think, you do realize that there's Trump coin now. What you can do is you can send your dollars to this particular group and they will send you Trump coin tokens. What they say, and this is from their website, I'm not making this up, okay? That they will, the investors, the people to whom you're sending the dollars, will use these dollars to make America great again by investing in infrastructure or paying veterans benefits. And presumably, I guess the idea is that you've made this donation, and because you got these tokens, if they go up in value, you really didn't give away anything. That's my view of it. But all I know is that about every week there are 3 or 4 new startups that are doing these ICOs, also sometimes called crowdfunding, to try to get it going. And well, if anybody wants to know, there's a great website out there. If you'd like to follow these things, the 700 that are in existence right now, I'll be happy to give you that website. And I've actually been tracking some of these to see how long some of them have lasted, what the patterns are, what they seem to be like. And I wish I could tell you something about which ones are going to make it and which ones aren't, but I'm not far enough. I haven't seen Bridge to Brooklyn coin yet, but some of the names of these things are actually crazy.
So let me just add to that. One of the reasons for that is that just ties in with what I said about the open source aspect. So the Bitcoin protocol itself is open source, so it's very, very easy for a programmer to take that and make their own spin-off.
Yeah.
The last time I checked, though, Bitcoin by market cap is about 95% of the market. So even though there are lots of them out there, Bitcoin is really the only game in town. And just to get back to your question about China, the reason so much of the Bitcoin is in China is because most of the Bitcoin never leaves the miners. So the money supply in Bitcoin is introduced to the system as a reward to the people who do the transaction validation. And most of that is, as I mentioned, without going into any detail at all, it's just highly computationally intensive, not because it's hard to verify transactions, but just because they have to do this proof of work contest to win the right to validate. And so that mining has moved to places where energy is cheaper. So it's done in Iceland, it's done in China, and there are other reasons to sort of get around sort of, currency regulations, why people want to do the mining in China. But the reason most of the Bitcoin is in China is because most of the mining is in China, and the money just sits there. So most of the currency that's mined just sits and is held speculatively by the miners.
The other thing that's kind of interesting, though, then I'll let other questions on the floor, is some of these people issuing these tokens are not actually setting up their own blockchain. They actually are climbing onto somebody else's blockchain. Like there's an entity out there called Counterparty that will allow you to actually have your other token transactions be on their blockchain. This one site that I like, it distinguishes between currencies, which are ones that have their own blockchains, and assets that are ones that are actually using somebody else's blockchain. It's a crazy world out there.
It occurs to me, one of the speakers said that paper currency is dumb.
That was
you. That's not a bug, that's a feature for many of the uses of it. And that, in fact, paper currency could trade at a premium to other currency if people value the anonymity for free.
Right.
It's not just to commit crimes. I mean, suppose you just want to buy something that your wife might not approve of. A $500 golf club. Or... Right.
Yeah, right.
Pardon me? Yeah, pay somebody on Craigslist for something. Or just for small transactions where you don't want the possibility of having your electronic currency payment rejected. That is, for no other reason than that your phone battery is low. How do you deal with the possibility of these different types of the same currency having different values, market values?
I guess I have to take that one step further back, which is, do you care? This gets into the whole argument of whether or not you think currencies ought to be, quote, uniform, that dollars should trade for a dollar everywhere, or think that actually being able to convey this extra information actually improves the payment system. Okay, and I'm of both minds on that one, to tell you the truth. We have a question over here.
I'm Chandima Mandis from Bridgewest Group. Has there been any work done on the impact of the emergence of these cryptocurrencies on velocity of money?
Velocity, what's the impact of velocity of money?
So I could say something about that. So there are a lot of people out there that have been trying to predict the future price or the future value of Bitcoin because if they want to engage in speculation. And so there are a couple of papers out there that people have written that try to do this using what economists call, it's the Fisher quantity equation, which relates the price to the velocity. So what you're basically doing there is you're recognizing that Bitcoin itself, the money, of course, there's nothing intrinsically backing it, so it has no value, but it is providing a service as a medium of exchange. And so that's not valueless. And so to the extent that it's being used more for exchange, that adds more value. And so there are people that are out there trying to measure the velocity of money in terms of Bitcoin, how often Bitcoins are used for consumer expenditures in order to predict future value. That's really tricky because a lot of coins shuffle around for sort of meaningless reasons. But that certainly is a very important component that people are trying to estimate in order to predict the future value.
But the problem with measuring that velocity is, when we do it in the United States, they do the velocity calculations and they do it sort of say, well, the transactions are GDP. But now with Bitcoin, it's all over. So what do you use for the income measure that's underneath the Fisher quantity equation? I have no idea.
There's a question over here.
Yes, Richard Tart from San Diego Serra. I came into this room about 0% understanding Bitcoin. I think I'm up to about 4 or 5% right now, but I'm not one of the 5 that can in the world that can explain it, as an earlier speaker said. But one of you and I have a pillar that I can't tell who it was. But one of you said something about the validation of a Bitcoin transaction, and that this was not only a big user of electronic power, but also a big impediment, or I can't remember the way in which you described it, but exactly what is validated by whom for what purpose?
So the idea is that you've got to do, you're trying to do two things when in the Bitcoin model. The protocol is trying to do two things, the system. It has to, first of all, when transactions are proposed, someone has to check. So there's a big ledger out there that people can read. And so people can see what your account is, not by your name, but by whatever your username is, your public address. They can see if you have those coins, and they can see that you're proposing sending one of those coins to me. So everyone can see that. And so that all sounds like it should be a valid transaction. So if you actually transmit that you're sending a coin to me, that could be included in a block of transactions. But now the problem is that you might try to send that same coin to somebody else. So we have to come up with a way to prevent this double spending problem, and that's where the proof of work comes in. If you have a central a processor, like a central bank, they have the books. They can not allow you to send the same coin twice, but then you have to trust the central bank. And so in order to get around the trust issue of having a central authority dictate or make sure that there's no double spending, then you need to have the system be able to do it itself. So how do you have the system do that itself without a single person being in charge? Well, that problem is solved by something called proof of work. And it goes back to an old problem that was known as the Byzantine's general problem. And it had to do with a Byzantine general that's trying to attack an outpost with a bunch of friendly armies. And they have to coordinate on the attack time. But there's no cell phones at the time, so people are sending messages. And how do you know that everybody's receiving the same message? And how do you know that someone's not sending a false message? So you have to achieve some kind of common knowledge. And the way you do that is you have everybody work on this long, complex, interconnected problem, which is completely extraneous to the idea of transaction verification, but requires a ton of work from the whole system to be continued. And that's what blockchain is. I haven't given you details exactly, but all you're doing is you're essentially engaging in a tournament with other people to solve a problem that builds on a previous problem. And what you're doing in that tournament is basically trying to pick a number between 0 and infinity by guessing over and over and over again until somebody gets it. And once somebody gets it, they announce that solution to the rest of the system. It's actually not actually picking a number. It's analogous to that. It's it's running a hash problem. They announce it to the system, and that solution gets agreed by everybody and added to the chain in a way that's connected to the previous solutions. So in the long run, what you get is you get this chain of proofs of work that are all interconnected, and everybody in the system knows that everybody's on the same page because they're all following the same chain. But that's completely disjoint or disconnected from the idea of just saying, is a transaction valid? It's all about preventing double spending. Well, that's one other kind of interesting thing, which is that there are a lot of alternatives that have been floating out there, like Ripple and other types of protocols that people have been proposing. One thing you can say about Bitcoin, people would love to have brought it down by now, and they haven't been able to. So that system is resilient.
Can I just follow up a little bit? I think what you need to distinguish is between Bitcoin, just the zeros and the ones out there, and the blockchain, which is the distributed ledger and the ledger on which these Bitcoin transactions are being recorded, being kept, okay? Making that distinction has helped me understand what little I understand of what's going on. In terms of bringing down the system, yes, it could be brought down if all of the people who are mining this stuff all kind of got together and colluded and said, what we will do is start another fake blockchain or another blockchain that basically allows us to double spend, or we take the money from we take the Bitcoin from these other people and put it in our ledger. And I hear anyway that the Chinese miners basically try to make sure that they don't have enough capacity sort of in their consortium to allow that to take place. I also can tell you that there are guys in computer science departments and
cryptologies that have basically analyzed this thing and kind of come up with a number for what's the percentage of the miners, what percentage of the total capacity do miners have to have before the system could really be brought down. And the lowest number I've seen right now is 23%. That if 23% of the guys got together and colluded, they could actually bring the blockchain of Bitcoin down. And so because the miners know this and they'd like to keep the blockchain going, they make sure that the collusion is not happening. This is what I hear anyway.
We have a couple questions over here.
Have any of you ever looked at Zappo, which is a Bitcoin credit card used in South America? XAPO, because I understand that they have a couple million users because it allows them to avoid all kinds of cross-country fees when they're moving money in and out of different countries in international exchange. And the second is, it's not really a currency, but I'm sure you're aware of M-Pesa in Kenya, which has 20 million users, and it's a daily used system, and it's private. Now I know it's run by Safaricom, but I don't know what supports it. But I know that they make a ton of money off of it.
They certainly don't want government money over there.
No.
That's for sure, with the inflation rates that they've had. So this is
but
probably.
But it's based on the Kenyan shilling, so they don't get away from that.
Right.
But it's an intermediary exchange system.
The Safaricom actually has to hold Kenyan shillings in the amount of the deposits that are made behind the M-Pesa system. They have to hold it in commercial banks. Now, that still doesn't make it completely safe because those commercial banks could get run, so it's possible that M-Pesa could get run. But M-Pesa is actually quite an impressive system, and especially in terms of it allowing P2P payments, which were very difficult in Kenya before then. And so it's done quite a bit to the distribution of economic activity in that country. There are a number of, there's someone at MIT who's been doing an awful lot of work on that, studying it.
I think it's time to close this particular session, and we'll go on to the next one. Steve? Good job.
I feel like the person who is associated with the famous phrase, taking the punch bowl away, that was really great. Thanks. So we have Dave Altig coming up. We have Preston and Jamie coming up. It'll be the final session. And there's Preston. All right, come on up.
I can't hear myself. Oh, there we go. I was looking for the voice of God to come up. So Steve earlier said that central bankers are the new rock stars. Is that what he said? Yeah, so that makes me Meatloaf. When someone, yeah, you got to have the right demographic for that. Yeah. So I remember the first time someone described Bitcoin to me, the thing that crossed my mind was, this is a really interesting payments idea wrapped up in a really questionable notion about monetary systems. The need payments idea, of course, is what we talked about sort of all day, this replacement of kind of this trust model that's very centralized, relies on reputation and legal processes, with this sort of blockchain idea of sort of distributed proofs that are all about the security of the system, centrally. But of course, everything we sort of have talked about today, has somewhere in it security at its very core. So Preston is going to follow up on that thought in his comments and discuss some things that'll probably scare the bejesus out of it. I think I heard some of this before, and I remember having the bejesus scared out of me. And then on the monetary system part of it, again, Rod made kind of reference to this notion that Bitcoin seemed like a philosophy and not an economic system. Wasn't really sort of completely thought through, and the sustainability of it seemed pretty questionable. I think Warren's comment sort of shows some of the way that we might get to a point where it is stable. But the part that I always sort of wondered about was this anonymity part. How could a system that's a ledger actually, at the end of the day, be truly anonymous, and what is the demand for anonymity, and what does that mean about what sort of kind of monetary system might ultimately survive? Will it really be cashless? And Jamie is going to take on that part of the discussion. So Preston, sorry I gave you the kind of head fake, but you're on now.
All right. First, let me get the business out of the way. I'm not speaking for Microsoft. This is not a Microsoft opinion, and I'm wearing some other hat. There was a question earlier about whether the Chinese are going to squash Bitcoin. Well, Bitcoin's back over $1,000 a coin, so the market doesn't think so. I know nothing about monetary economics, money, and the bit I know about Bitcoin is I bought them back in 2011 at $12 a piece. It's far and away the best investment I ever made. Okay, I'm going to talk about security. The thing that's coming as a tidal wave is the Internet of Things. What is the Internet of Things? It's primarily cheap devices. You're looking at a bunch of cheap sensors, cheap processors. Some of these sensors are down well below a penny a piece. And what that means is we can distribute them all over the world and collect data on everything. Here are two sort of silly examples. I actually have some of these. They tell me when my potted plants are dry. And they tell me by Wi-Fi, connect to the system, and I get a little pop-up that says water the plants. This other thing is a fork that pays attention to how much you eat and tracks that automatically, and will start to vibrate if it thinks you're eating too much.
That's why my hand is shaking off.
So, some headlines. Okay, drug pumps have already been hacked and can deliver a fatal dose of medicine to you. Some guy hacked into a bunch of chicken farms in South Carolina, managed to kill 300,000 chickens. By the way, if you want to know what the single biggest threat to the society is, it's disgruntled employees, ex-employees. And then finally, here's a guy had a light bulb do a denial of service attack on his house and bring down his house. Routers are insecure. It's actually in this room with this age demographic, how many of you have ever updated the firmware in your router? Not bad. Was what, 5? What that means is the rest of you probably have a hacker controls your house. Because if you haven't, unless your router's brand new, you have old router's firmware, and you haven't updated it, none of them, no one's updates automatically, except I think Google's might. So if you've bought the new Google one, it's just out. They don't update automatically, and they're insecure, and now the modern denial of service attack comes from your router. That's how we attack. Here's some more headlines. So notice, this is like all of them. At least economically. By the way, this updating of the firmware. So the firmware is the software that runs the device that's built in. So if you whenever it doesn't work, you unplug it, you plug it back in, that brings the firmware back up again, and so it kind of starts over with the firmware. And with IoT, with the Internet of Things, you typically can't update the firmware. There's no mechanism. You'd have to send it back to the factory. So the effect of that is we're stuck with it. Security cameras. How many of you have security cameras? Okay, I can't believe 2 people total have security. Ah, we got some more. Okay, so this is a site, insacam.org. You can go to it on a phone. You can actually look at this on a phone. What this site shows you are hundreds of thousands of insecure, that is, didn't change the original password to their security cameras. And actually, while I was sitting in the audience, I went and looked today, and you can see, like, there's elevators, there's inside restaurants, there's a bunch of people in a swimming pool who didn't change their password. So all of this is insecure, and you can go and have fun. Okay, this is a fridge for sale in a major store. I'm not going to name it. And it's got pornography on the cover.
How much you got to pay for that?
Actually, I don't think the porn is extra. I think that they're working there. Okay, ATM theft. We have skimmers. Something like 1 in 8 gas stations in Los Angeles have skimmers on the payments, and they're estimating this at more than $1 billion of theft a year. These things have gotten very sophisticated. So 3 years ago, you look at the ATM, you can actually see the device that's going to skim your credit card information. Now the stuff is, it looks like something out of James Bond. It's like perfect. You can't tell that they've skimmed it. Another headline: the fintech facilitating fraud. Cloud security. So these guys, this is a company called Netscope. Now, to be fair, they have a little bit of a bias because they're in the business of selling security software. But for their customers, 1 in 7 corporate accounts have been hacked. So what they find is when they come in, 1 in 7. So you look around the room. Already have already been owned, and as we do more and more of our business on phones, these things are wildly insecure. In fact, you heard a glimmer of this about Amazon. Why does Amazon need your contacts? Well, why does every app that you have? It's actually 15% of apps in the Google App Store. At least that many in Apple, probably worse, but at least that many. And the way this works is you get a free game. Free game does not take your contacts. It asks for permission to take your contacts, but it doesn't take your contacts. It doesn't actually care. What it does care about, though, is the ads it shows you. And the advertisers want your contact list because they're going to spam your friends. And so ads that run on, you wonder, like, why does this game use up so much of my battery? It's because it's sending up to the cloud all of your contacts over and over and over again, because many advertisers want that. And so the devices, in fact, it's basically the case that almost no one has a secure device, simply because once you put software on it, once you put apps on it, it's insecure. The thing that we find kind of alarming at Microsoft is Sony essentially devastated by hackers. Target pays tens of millions of dollars. Actually, though, there's a claim running around Silicon Valley. I have not audited this claim myself for its truth, is that it would have cost Target more to protect itself than it paid in fines. and you know, in the make good. I don't know. I find it really annoying that about once every 2 weeks I get a new credit card number because they send me, you know, without me asking for it, I get a new credit card with a new number because my old one showed up on some Russian website. Okay. One of the things that we're doing with all this data is we're going to process all of the data that comes from the Internet of Things. We're already doing this. You actually heard some of that earlier. With big machine learning algorithms. And just to put this in perspective, what is a big machine learning algorithm? Well, there's a major internet search company runs a logistic regression with 1 billion right-hand side variables. Now, here's the thing. We all know, we've all taught correlation is not causation, so I want to talk about, but we're going to have to relearn that the hard way, and that's one of the things that's facing us. And oops, there's the cloud security. I got off on my slides here somehow. This is so you've heard half the money I spend on advertising is wasted. The trouble is I don't know which half. So I was pitching an advertising product when I worked for Yahoo, Google, Microsoft. All of them do advertising. I'm not going to tell you who, where I was pitching this or even who the customer was. But we're pitching a measure how effective your advertising product is. And they say, we know how effective our advertising is. And they whip out this chart, and it looks like this. It's got a bunch of data on it, and it's got a line through it. And on the bottom axis is their advertising spend, and the vertical axis is their revenue. And they say, this line, you know, we fit a line through these data, and they are, and that's our return on investment. And so we asked, why do you spend more sometimes than others? Oh, we spend more at Christmas. So the theory under which this measures advertising effectiveness is the theory under which if you don't advertise, Christmas does not come. Okay, so there's a guy that's really worth knowing, Tyler Vegan, and he's got spurious correlation. So this is U.S. crude oil imports from Norway and drivers killed in collisions with railway trains. Could be correlated, after all, and pretty much every economist I know can come up with a good theory under which that's correlated. Number of people drowned in swimming pools in films of Nicolas Cage. This is very correlated. The age of Miss America and murders by steam, hot vapors, and hot objects. Okay, let me finish up with a few other thoughts. So first, it is true that Bitcoin is over 95% of the value of all the coins. Bitcoin seems to be pretty well, it's not just Chinese, it's also like South American drug dealers are using it. It's a great way to transfer lots of money that's illegal. So number two is Namecoin. And Namecoin has a really interesting business model. Namecoin says, so suppose you want to buy BowlingGreenMassacre.com. Well, you'll find that's taken. It actually goes to the ACLU. But so now you go and you say, I want to buy a website, and I'm worried about it being taken away from me, because they do that, right? The government, you know, if you buy, let's say, a cuss word Donald Trump, it's going to probably be taken away from you. And so you might want to get this and get it in a way that can't be revoked. Well, that's what Namecoin does. So Namecoin owns the entire .bit. BowlingGreenMassacre.bit, currently available if you want it. Actually, McAfee.bit turns out to be available. So I've got something to do tonight. So here's how this works. Is if I go and buy McAfee.bit or BowlingGreenMassacre.bit, I buy it with Namecoin, so I have to put dollars in, I buy Namecoin, I use those to buy that. My registry for that name gets embedded in the blockchain. That is the Namecoin blockchain, which you've now heard about, the publicly distributed ledger. there's no mechanism by which anybody takes it away from me because they can't verify it without my private key. The only way I can get that this can be taken away from me is if I give my private key to someone else. Or that is, I say I'm going to initiate the transfer, which requires my private key to release it out of my own name. As a result, the link that says resolve this to my IP address can't be taken away. And so what they've done is create a fully autonomous web directory that can't be controlled by a government. It's a very clever, very clever use of the blockchain. Now, the thing is that this Namecoin can actually operate without any humans. It's just a ledger. And so, oh, this is the Namecoin website. So what it also suggests, and what we're looking, what you need to be looking for, is fully autonomous businesses. So that is the Namecoin makes a profit. It could invest in that profit. It could, let's say, buy cars and put those cars out on the road and hire drivers and maybe even hire accountants and pay taxes. But it would be a business that's not actually owned by any humans, just operates autonomously. So this decentralized businesses, decentralized markets, you know, the Silk Road was taken down because it had a single point of failure. If it lived as a distributed ledger like Namecoin, essentially there'd be nothing to take down. You'd have to somehow erase every copy of the ledger in order to take it down. Okay, finally, let me talk a little bit about fragility and resiliency and our dependence on the electric grid. And so a few years ago, there was a flood in Thailand which took out a lot of hard drive manufacturers and left us without the ability to make computers. One of the things that the modern supply chain has done is become extremely long and fragile. The Carrington event in the 1860s, if that happens, it took out the telegraph system, because there was a telegraph system, but if it happened today, well, so what do the predictions look like? The predictions are, let's see, I think I even focused this in, basically we're all going to starve to death, is the predictions of this. Because once you shut off the electricity, the food spoils in the grocery stores, the hospitals go down. Okay. I don't think you can get more dismal than that. So let me just stop there.
We guess we want to applaud for that.
I was going to thank Steve and Dave, but they made a mistake. I wasn't supposed to go on after Preston. You know. I don't know what happened there. But I do want to get one question out of the way. In case Preston is going to dinner, how do you update your router? This will save you 15 questions. No, we won't go into that right now. But anyway, no, thanks very much for inviting me, Dave and Steve, this wonderful event. Certainly enjoyed being in San Diego, notwithstanding the Northeast is enjoying a good couple of days. But that was a fascinating discussion. All of the discussions have been great today. And I'd like to talk about something that, notwithstanding all the incredible good things that we've heard, although Preston pointed out a lot of the dangers, he also pointed out tremendous promise in these autonomous corporations and autonomous contracts and so on. The stories of InsureCard, Honey, SupiPay, fantastic new abilities in payments and so on. But I'd like to, and I fully acknowledge that there are just extraordinary benefits. The list that Bob Eisenbeiss put out earlier showed all the different types of payments there. He pointed out a very simple thing with regard to credit cards, that you know, credit cards is very different from cash in that you can borrow if you want to along the way. You know, just a fantastic increase in human abilities and capabilities. But I'd like to point out that one thing that we may be losing as we go from the paper to the digital world, and as Rod Garrett pointed out, we've been in this digital world for a very long time, and that is the notion of anonymity. And I'll use anonymity somewhat broadly, but I do mean this idea that Warren Weber pointed out. With anonymity, possession is the law. It's not 99% of the law. It's the law. If you have the cash in your hand, then that's your spending power. So there are many great innovations. But if we could go to the, let me see, where's this? Oh, here's the slide. Okay, thanks. That's quite all right. There are some advantages of anonymity that we may be losing, and these could be, you know, fairly far-reaching along the lines that Preston reminded us of in one case. So there's a great economist, Narayana Kocherlakota, recently president of the Minneapolis Fed, now at the University of Rochester, and he has this wonderful paper entitled "Money is Memory," and he showed that if you had a public register, this is kind of like a science fiction idea he had, a public ledger of all the transactions. And he said that is what money is actually providing to society. And the way he did that is he said, assume you have this you know, science fiction public ledger that sees everything you do, every transaction you've made since birth. And then contrast that in a world with money. And he took 3 different models of money that economists had used in the literature, and he showed that the same allocations could be achieved in the world with money as in the world with this great public ledger in the sky. So what he was pointing out, that his theory of money is that money is a reward that you get for doing something good in the past. So the farmer grows the wheat, he gives the wheat to the baker, that's a good thing, and he just gives it to the baker. But that's recorded in this public ledger in the sky, and then the farmer later goes to the shoemaker and says, would you give me some shoes? And the shoemaker said, why should I give you some shoes? And the farmer says, well, I did something good in my past life. I gave these bushels of wheat to the baker. And the shoemaker says, aha, I see that you did that, we'll do the transaction. All that can be achieved with money as well. And that was Kocherlakota's point, that money can achieve the same thing as this social memory. Later, I wrote a paper with a couple of colleagues, Charlie Kahn and Will Roberts, that was called Money is Privacy. And we pointed out that if there's someone out there who wants to send you and your buddies advertising, I won't name who that might be, then that social memory is not such a good thing. And that if you could choke off that kind of record of your behavior, you could actually achieve more allocations in society. So that if you had anonymous money, anonymity is really doing something more for you than this ledger in the sky. Recently, 2 other economists, Awaya and Fukai, have a very nice paper showing that, you know, in a world with incomplete information, we can't agree in that common knowledge that Rod was talking about. Same sort of thing. Anonymity can foster more sorts of transactions than this public ledger in the sky. People won't contract if they know that every move they make will be put in this public ledger. It's not necessarily that you want to buy the golf club that your spouse won't like. It's really that you won't buy things that your spouse will like. So this friend of Rod's and mine, I'll use his name in vain, Thomas Eisenbach, a really great economist, works at the New York Fed. He wants to give his wife a gift. How in the world does he do it? His wife's very intelligent. They've intertwined their digital lives. He has to steal money every week, just a little bit of money, So, you know, like for 26 weeks, finally he can get that Christmas present without her knowing. So there are all sorts of transactions like that. Garage sales, they're asset sales. They're not hiding taxes or anything like that. You know, you use cash for all of these things. So cash and this anonymity is a very good thing. Now, there are bad things about anonymity as well. It supports criminal transactions, illicit transactions, tax evasion, as we heard earlier. These are terrible things, we all agree. But can we really get rid of those things by going into a digital world? I don't believe so. So Narayana Kocherlakota in 2016 gave a talk, and he said we really need to think about money differently than the characteristics that Bob Eisenbeis showed. Or Warren, I forget exactly which slide it was. Money provides a medium of exchange, it's a store of value, it provides a unit of account, and it provides anonymity, that this is a key feature of money. And in all of these digital monies we heard today, nowhere is that anonymity provided. So the question is, will these digital currencies provide the right sort of answer for us as we move away from paper currency over time? What's available now on the internet? Well, there are all sorts of private types of monies on the internet. There's the credit cards, the PayPal, InsureCard, Honey, SupiPay, all of these things that use the normal national denominations. All of those were in dollars. There were also suggestions that central banks could issue digital currencies such as CADcoin, as Rod talked about, and this blogger's idea of FedCoin. But there are also these so-called currencies like Bitcoin that don't use the national denomination. They're just a different asset. Economists would call these bubbles. They have no intrinsic value whatsoever. Their price just fluctuates, and they're hoping that people will begin to use them as medium of exchange, and if enough people use them as a medium of exchange, then they will have an ongoing value beyond their pure bubble value. And Preston can cash out, and he will have not just paper profits, but actual profits. Now, here's my question. We heard Rod's description of the Canadian experiment, but it's my question to the room, will central banks provide an anonymous e-payment? Central banks distribute currency today, and that's anonymous, that's represented on their balance sheet as a liability, but it circulates out in our wallets and so on. Again, possession is the law. Nobody knows who has these or who's paying or anything. By the way, cash payments make up over 40% of the transactions under $50 here in the United States. So cash is very widely used. Will central banks, when they, suppose the central bank does put in place a CADcoin, or the PBOC actually does put out an e-payment, or something like that, will it be an anonymous form of payment? I don't think so. This is just my conjecture. Why not? Because there are very legitimate issues about a government agency putting out a type of payment that overlooks the money laundering and terrorist financing rules that are in place for banks. And Federal Reserve banks have the same sort of, operate under the same laws as the national banks. The Federal Reserve Bank inherited the National Banks Act, so they're all national banks, so they all have to, adhere to OFAC and Money Laundering Act. Would they, voluntarily issue new types of currency that were anonymous? I just think it's very implausible. Paper currency was sort of grandfathered in that sense. Will anonymity be privately provided? Well, we just heard from Preston, no way will it be privately provided. We've seen how pernicious the leakage of personal information is in internet transactions. And Honey's operating on advertisement, although that was a very interesting type of advertisement, where you have a specific seller coming back to the person. But, you know, Preston was talking about Apple and so on. They want to download your contacts and then send everybody advertisements from there. That's just, you know, the opposite of anonymity. And that's exactly the sort of thing that my co-authors and I were writing about in our paper. That's ex post predation. That's what I call ex post predation. So you do some transaction, I download a song by Lady Gaga, and then the rest of my life I get advertisements. Not only I, but all my friends get all sorts of advertisements that, you know, far outweigh the benefit I got from the song from Lady Gaga, which was just okay, you know. Now, some of these virtual currencies, like Bitcoin, are pseudonymous. They know your wallet. Because in this ledger, they have to know where something is. They know where your wallet is. And this Silk Road was brought down using, you know, very careful detective work. They were able to identify many users of Silk Road and in fact, were able to successfully prosecute them and put them in jail. So it doesn't offer anonymity. Now, some of new currencies, Dash and Monero, some of these 700 currencies, are offering anonymity. My question is, will these currencies ever actually get going? Will Bitcoin ever be successful? And I don't think it ever will be. I just don't believe that a privately issued, non-backed instrument such as Bitcoin will ever become widely used as a medium of exchange. That's consistent with what Warren was pointing out. Warren was saying you have to have a government there saying it's a legal tender before it will be widely used. They lack what monetary economists would call liquidity, the chicken and egg problem of adoption. I'll adopt it if everyone else adopts it, but you know, will they adopt it if I adopt it, and so on. Now, nations have a tremendous advantage to make a currency legal tender, acceptable for taxes. So there's this big user who says, bam, this currency is legal tender. That, you know, Bitcoin doesn't have that advantage. So it has a significant adoption problem facing it. And right now, by and large, it's just, you know, a store of value. It's not really a medium of exchange, and its value just floats along just like, you know, other sort of bubbles where there's nothing, it never pays a dividend. It's just, you know, it's just a price out there. So my conjecture is, now, the one thing that I haven't told you is how much anonymity should be provided. And that I don't know. We haven't done enough economics in this issue. But my conjecture is that the anonymity of internet payments will be vastly underprovided by the private sector. Visa, PayPal, all of these companies face two impediments in providing sufficient anonymity. And so here's the economics of whether anonymity will be provided by the internet. You know, one economist would say, oh, of course anonymity will be provided in the optimal amount because of the Coase theorem. The Coase theorem is this idea that people can get together and bargain and come to a sensible agreement. But that's not going to happen in this case. Why? Because the providers have an inability to commit not to use the information gained. Apple gets a hold of your contacts, it just can't help itself but, you know, use that information. And if they don't use it, they will be bought by somebody who will use it. That's the, you know, that's the problem, is that, you know, once they have your information, somebody else is going to get a hold of it. Somebody else will take over the corporation and won't abide to the commitment that the first person made. The second point is the usefulness of the information that is revealed is dependent on a host of related information made by the, related investments, made by the parties. So this is Apple, you know, investing in all sorts of users. You're just one user. Your transaction is worth almost nothing to them. And they've made all these investments in advertising, and Google has all these auctions running and so on. And they can gain so much from that information of the transaction. The transaction itself is very small, and it's made hundreds of millions of dollars of investments in those systems. And so there again, the bargaining between you and Google is not going to go well. Finally, on the consumer side, the information revealed by a consumer may have external value. So this is something that, you know, when I give they say, oh, please put in your zip code. We were talking about this earlier. And I put in my zip code. I said, what does it matter to me if Amazon knows my zip code? Well, it really doesn't necessarily matter to me very much. And I'm willing to give up that information freely, you know, essentially. I'm not getting any compensation for that. But then that can be used in that billion, you know, variable logistic equation. And the prices for everyone else in my zip code can go up because I bought that crazy book on Amazon. And so the consumer will not bargain correctly for the value of that information when it reveals its information to Amazon. So in this environment, you know, Coasian bargaining is just not going to work, and we won't have the optimal amount of anonymity. And a lot of that is reflected in these problems that Preston is talking about, that, you know, the information is so readily available, and using big data techniques, it can be used to engage in predation on consumers. So my conclusion is that, you know, physical currency offers this anonymity, and it can be valuable to society in a variety, you know, just a wide variety of environments, not just in criminal or illicit transactions. So there's some good value to that anonymity. It's not all bad. There's some good and some bad. The internet is this information-rich environment because of the ability to collect information cheaply, and the private sector just doesn't have the incentives, even if allowed to bargain with all the consumers, to provide the right anonymity of transactions. So my conclusion is that public authorities have a very important role in promoting greater anonymity and greater anonymity and privacy in internet payments and transactions, and that's sort of the backbone of the internet. And if we were able to provide greater privacy and anonymity in those situations, it could, you know, have good effects on the internet more generally. Thanks very much.
With respect to your last, Josh Mendelson, with respect to your last comment, government has an interest in this. In terms of where governments are going these days, and I'm not just talking about here, more generally, doesn't the government actually have the opposite interest in order to retain and collect all this information, as we've seen with all the exposures of attempts to, you know, lock up every bit of information? So I'm just wondering, who is the ultimate body that might actually grant us this anonymity?
Well, I think that's a great question. I think governments, as you point out, do have a great interest in this information. They collected, as Director of Research at the Federal Reserve Bank of New York, I had top secret clearance, and so you know, you have to fill out this huge series of questionnaires, including everywhere you and your family have traveled for the last 10 years. And of course, China then stole that information from the United States. So both the United States and China seem to want my information. It seems useless to me. But you're right, government has information for security purposes. They don't have the, you know, a desire for that information from the commercial purposes. So we could separate out those two things. So I think that what I'm pointing out is that for the commercial purposes, there is a role for greater government regulation, much like our colleague in the InsureCard was talking about the HIPAA regulations for health privacy. We could expand that sort of regulation to, let's say, zip codes and other pieces of personal identifiable information. And there are regulation within employers and so on. You can't release personally identifiable information within, emails and things of that sort. We could expand that notion of what is personally identifiable in the world of big data, for example, that could, I think, go in the direction that I'm talking about. Good question.
Hi, Samantha Begovich from the San Diego County Employees Retirement Association. It strikes me, and this may be naivete on my part, but this race to create this digital currency is sort of a solution, or solutions in search of a problem. So I'm not quite sure of the why. So could each of you say sort of a one-sentence answer as to why there's this rush to create this sort of redundant currency in some regard?
So I'm happy to start with that. What really sustains Bitcoin, and anyone who thinks Bitcoin's going away, I think is just wrong, is illegal activities. And the problem of illegal, like if you're a Colombian drug lord, the problem is the size of the cash. $1 billion occupies a very large space. Moving money around, especially moving $20 bills around, was just hard. Actually, there was an incident where a Mercedes and a BMW collided in Miami. Both drivers got out and fled on foot. More than $1 million in cash, several machine guns, and a kilo of cocaine were recovered between the two cars. The volume and the security of it, I think, has been a problem. And so this ability to move money for illegal purposes, to move money across borders, because anyone who's, I think we heard earlier, if you've dealt with the SWIFT system, that's a misnomer. So I think that's what underlies it. And in fact, actually a point I wanted to make that I don't think has been made yet today, or at least hasn't been made in the afternoon, is that if you actually look at the cost of a transaction on Bitcoin, so this is just for per transaction, what does it cost for me to transfer money? And what I'm going to do is take the total spend on hardware and then also the energy spend. Now, hardware is durable, so you got some issues there, and so I amortize the hardware over 3 years, and the energy, obviously immediately, and you get a minimum of $5 and a maximum of $24 per transaction. So obviously there's some assumptions as why there's uncertainty about this. The costs of a Bitcoin transaction are huge. This is the proof of work piece of it, is very expensive. So even though I actually managed to buy a cup of coffee in Seoul, Korea with Bitcoin, just to say that I could do it, which has been paid lots of dividends, as I've said it many times, it actually costs more to verify that transaction than the coffee cost. So I don't see that as being a long run. The MasterCard doesn't need to be worried about Bitcoin. SWIFT maybe, but not MasterCard. Transactions are much cheaper.
Yeah, I think that outside, I think, Preston's comments are outside of the illegal use. I don't see a business case for, Bitcoin or these other coins. They're bubbles. They're financial assets that pay no dividends, and, they're not widely used as media of exchange. So criminals are using them as storage of value, and as Rod, importantly points out, most of the value is held by these, mining interests in China and Iceland and so on. Now, what we heard today, though, was very different, which is the extension of electronic means of payment in payments denominated by dollars. InsureCard was a great example of that. I mean, that's just terrific that, the insurance companies can pay more reliably on time to claims holders who need the money. They're constrained by liquidity. They're not working now. They have a some sort of disability, possibly temporary disability, and they get their claims money on time. That's just fantastic. So there are all sorts of reasons. Honey and SupiPay were showing how certain little person-to-person payments can be made more conveniently and at low cost. So I think there are different you know, business models throughout. Again, going back to the slide that Bob Eisenbeis put out, all those different types of electronic monies, credit cards, debit cards, gift cards, ACH, Fedwire, which, by the way, is not going to go away anytime soon. SWIFT is going to be here for a long, long time, because those are for, you know, above the table transactions. These all have their, you know, their business model. And again, I really want to, I thought the InsureCard case was just a great business case of how a person builds a business using the credit card, you know, system, credit and debit card system, and finding ways to, you know, apply the interchange fee to solve different business problems. Is a beautiful case of really finding value. And there are a lot of more cases for that. So we're going to see, you know, extension of digital payment and electronic payment for a long, long time, because there are just tremendous opportunities out there.
David Burson. Jamie, at dinner I'll take about 1 minute for me to tell you how to update your the firmware in your router. It's actually pretty easy, and you're right, President, nobody ever does it.
Oh, great. Thank you.
Follow up on Josh's point and extend it. You haven't considered, or maybe you have, just didn't talk about it, with public versions of Bitcoin, the possibility of bad actors in government using the information. If FedCoin was in existence today and I made a contribution to a George Soros organization, would Donald Trump know about it? If Mrs. Clinton had won, and I made a contribution using FedCoin to a Koch brothers fund, would the IRS know about it? And I think that there is no anonymity in any system, even one in which the government says, we will not disclose.
Well, I will give two answers to that. First is that, as I mentioned at the end, I don't know how much anonymity is the correct amount of anonymity out there. You know, we have anonymity in our physical currency just because that's the way it works. That's a technological constraint in physical currency. It's not that it's the best amount of anonymity. And I don't know what the best amount of anonymity is. And your point is well taken that one of the downsides of entrusting any actor, including the government, with providing the anonymity as a central source, as opposed to a distributed system much like physical currency, is that central source could get infiltrated by the Russians or the Chinese, for example, and that information would be revealed to, you know, a bad actor. I have much more faith in our governmental institutions, but nonetheless, again, as I was pointing out, the Chinese and the Russians have successfully hacked us in many, many cases in our government, which is a real concern to me.
Bob Eisenbeis, this is a question for Jamie. You were the only one that mentioned legal tenure and legal tender. And the only legal tender is coin and currency right now. And yet, we have government guarantees through deposit insurance on a lot of other bank liabilities in some sense. So I started out thinking that legal tender might be if a Fed coin had a legal tender component attached to it, that might be an added advantage. But then thinking a little bit further, it's not clear that maybe it's the act of government acting like it's legal tender and accepting it in payments is perhaps more important than even the legal distinction. Do you have a view on that?
No, that's a very good conjecture. I don't know about that. I would say, kind of, you know, related to your question is the Warren's other half of Warren's story. So, as Warren pointed out, in the National Bank Act, the U.S. government taxed the issuance of state banknotes, which essentially killed the state banknote business, as Warren pointed out. They were taxed out of existence, but at the same time, then deposits, the state banks didn't dry up and blow away. They found a new way of serving their customers by offering them deposit accounts and checks, and that was a new form of currency. And although it didn't have the legal tender garnish provided by the government, it was denominated in U.S. dollars, and I think that's a key feature at par. Yeah.
So I was imagining a day 5 years from now where InsureCard is bigger than Microsoft, SuppyPay is bigger than Google, and Honey's bigger than Facebook, and just everything's electronic. And then I'm thinking of Preston's world, and at what point do you cross the line where a Chinese attack or a Russian attack, or the kids in the high school don't realize they let go a virus, and the system really locks up you? And I tell you that because I'm remembering Barbara and I are walking down the street in St. Helena, and the line is out the door at the local coffee shop and wrapping around. I'm like, wow, what happened here? And I go in, and the registers had gone down, and they couldn't function.
Can I supplement that question and say, do you have any? What is your solution to this problem that you see?
Yeah, no, I think we're. So actually living in the corporate world has made me more convinced of the evolutionary explanation of humans. I actually don't believe people are rational now. I think they actually just evolve. And so we actually have to experience the problems before we will fix them and before we'll sort those out, which is what makes me so nervous about the length of our supply chain and so on, is that we've put ourselves in a very fragile situation. Now, banks, actually, one thing I will say is, in my experience, the banks actually are better about security. They're more realistic about security. They were target number one. And so where Sony or Target aren't really thinking about security and are somewhat, let's say, I'm sure Sony isn't anymore, but very few companies actually reacted to Sony to sort of secure themselves. Is a surprise. The banks have been, because they've been under assault all along. You saw this attempt to take $1 billion out of Pakistani banks, was in the news, and it only got foiled, and foiled means they only got 81 million, but they didn't get the whole billion out because it triggered something, and someone said, "What's going on here?" and paused it. Which is a really kind of, it's not the right way to run a railroad. But I actually think we need to have that kind of meltdown experience before we'll fix it. 9/11 did this, by the way. I mean, a lot of the investment banks in New York had all their records stored in New York, and it didn't even occur to them that that was a security risk. Now, banks tend to have at least 3 geographically distributed copies of every database. So you make a transaction, it immediately gets propagated out to 2 other copies so that even if New York melts down, they can recover. But again, that took 9/11 to cause that to happen. And actually, this is what I'm expecting, is that we're going to have a pretty rocky road where we're just, and you can kind of see it coming. And we Microsoft can go till we're blue in the face and say, what about Sony? What don't you get about Sony? And they're, yeah, but it's expensive to secure all this stuff. And moreover, people find it really inconvenient. I mean, are you using 2-factor authentication on your email? So show of hands on 2-factor authentication on your email. Okay, you have a job for tonight. If you're not using 2-factor authentication to secure your email, because once I take over your email, I've got your banking. You get stuff from your bank that allows me to know enough about you to go redirect your banking information to my account, at which point you've lost control. I now control your banking. And so this is, and 2-factor just means in order for you to log in, you have to verify the login, not with a password and with your phone, is 2-factor. This is kind of a minimal level of security, and yet very few people, everyone says, it's all so inconvenient. But it's really critical. By the way, let me say 2 other things. One is Amazon got caught pricing by geographic region, and they pledged never to do it again. So this is like 10 years ago. So I'm sure they're kicking themselves for having done that, but the thing about Amazon, though, is that they said that they don't do that by geographic region, but they do it by time. So prices go up and down and up and down. And if you haven't seen the site, camel.com, easy to remember, 3 camels, but not 3 camels, camel.com. They will give you the price history of any Amazon item, except books, for the last 6 months. It's a really useful thing, because you see, it's literally doing this. And so if you don't search, you pay a good bit more on average than if you search. By the way, Camel lets you set, I want the 80th percentile or the 20th percentile price, and they'll send you an email when the price reaches that level. And so if you're not in a hurry for something, like you're buying a new set of golf clubs for your wife, you can set that thing, and it will send you the email when the price falls to that level. Let me also correct something that James said. It's not, Apple's actually pretty good about your data. Apple's pretty good about your privacy. They don't see that as their business model, as using your privacy, and so it's not Apple. Okay. It's parties in the Apple App Store, not Apple. Apple actually is the reverse, is that they are really quite good about your privacy as companies go, but the App Store is not.
Yeah, thank you, thanks.
Because I don't want to be accused,
right,
I just
right.
see Microsoft economists. And,
Thanks.
So I want to thank everybody.
Hey, thank you.
A couple of housekeeping items. For those, this is your first time here, we hope you come back. It's really great to have you. For the National Business Economics Issues Council members that are here, that will be here for the meeting tomorrow, and for the GIC members and their connected parties, there are trolley buses that are going to be in the lobby at 5:45 and probably 6:10. It's the same bus going back and forth to dinner, and we're inside. And so thanks, everybody. Have another round of applause.